folks, but we are getting through the disruptions. My name is Ernie Aboud. I'm Vice President and Midwest Conference Series Sales Director. So I want to thank everyone for being with us this morning. I want to thank you very much for putting up with our emails to promote and market this conference during these challenging times. Not to be deterred, Midwest Real Estate News is committed to the St. Louis market, cover it editorially, but we feel very important to gathering to see our professional community together to hear and get an accurate assessment of what is going on with this particular market. I'm not sure what to think of this unthinkable year, but there's been a lot of crazy news out there, but I'm very, very confident that we've assembled a strong group of speakers today to give an absolute fair market assessment of what's going on in St. Louis. And it's a full gamut covering the multifamily sector, which we have up here today, right now. We'll then get into the market update by sectors, and we will then get into the developer panel. And I can tell you we have some excellent developers that are going to be showcasing their projects with a PowerPoint. So you want to stick around for that. There's some really, really good stuff going on in the market that's going to fundamentally or change the market area, the neighborhoods, and so on. So again, I want to thank everyone for being here with us this morning. We have about 55 virtually, so I want to say good morning and thanks again for tuning in remotely. We do encourage questions from the audience and questions from those remote, so please take advantage of that. We don't have a formal break between each panel, so be mindful that we want to keep it moving with respect to being on time for those that have remoted in. I'd be remiss if I did not mention our sponsors. Huge, key, integral part of putting on this program to support it. And our team has enjoyed working with our sponsors to support the program and really meet and exceed their market share, if you will, with respect to this particular market, as well as other markets throughout the Midwest. I'm going to mention the sponsors for a second. That would be Sparrowhawk, Berkadia, CRG, Mueller-Prost, Block Hawley, Clayco, Broadmoor Group, St. Louis Development Corp., Newmark Grubb Zimmer, CBRE, Green Street St. Louis, Corfac International, two associations I want to mention, SIOR and CRE St. Louis Chapter. So I want to thank all the sponsors and thank the associations. Let's give a round of applause for them, please. Thank you very much. CRE, how many's here from CRE? Where's the CRE? Okay, we're going to take a photo of CRE after the event. If hopefully you'll stick around, we'll take that photo. There's going to be post-event coverage on Midwest Real Estate News. So thanks again for partnering and promoting the program for women of influence. Having said that, I don't have really much more to say. Let's keep it on time. I'm going to turn it over to John Morrissey, and John will, as moderator of the multifamily program panel, will take it from here. Thank you, John.
Thanks, Ernie. Thanks everybody for coming out today. It's been just so nice to actually get to see some people in person. I think this is the first time I've put a business jacket on since March. So it feels great to see everybody. As Ernie said, we'll be up here discussing the state of the multifamily market, in particular as it relates to St. Louis. So before we dive into the conversation, we'll do some intros. I'll be moderating. John Morrissey, I'm the Vice President at the Broadmoor Group, and we're based locally in St. Louis, and our focus is on multifamily value add.
Hi, my name is Pat Garlick. I'm with Berkadia. We deal with commercial financing as well as investment sales all throughout the U.S. We have a local office here in St. Louis. Typically, Andrea is up here, so I apologize that you don't get to see her lovely face and you get to see mine instead. But if you do see a fly on my head, let me know and I will knock it off.
Good morning, Matt Buchstummer. I'm a vice chairman at CBRE. I focus on multifamily investment sales throughout St. Louis and also some other Midwestern markets. Glad to be here. So again, thank you.
I'm Jeff Tegetoff. I'm an operating partner at CRG, which is the real estate development arm of Clayco.
All right, so we'll get into the questions. Here we are about 7 months or so into a COVID world. Let's talk about cap rates. Where do they compare today? Where do they compare, pre-COVID, and where do we see them going in the next 12 months or so?
I'll start out with that question. So it's interesting from a multifamily perspective, believe it or not, cap rates are lower than they were pre-COVID. And it's fundamentally a few reasons. One, there's a tremendous amount of capital on the sidelines that's trying to get placed. So there's a big imbalance right now of capital with investors trying to place their equity. And then you couple that with interest rates where they've gone, and, Pat will get into the interest rate market, but, you're seeing rates below 3% on fixed rate debt, non-recourse for multifamily. So the combination of equity on the sidelines, unbelievable interest rates, and fundamentals in multifamily with extremely strong collections, the renters are continuing to, surprise owners throughout the country, especially the Midwest with, collections. I'm seeing roughly 97 to 99% collections consistently from owners that I'm talking to. So those three big check boxes on equity on the sidelines, interest rate, favorable fundamentals in the multifamily space are actually pushing cap rates lower through this, COVID market that we've gone through. So,
All right. So as far as transaction activity goes, we discussed yesterday in our pre-conference call that there was a little bit of a pause after COVID happened and things started to pick back up a little bit. How has it gone over, since the summer going into the fall, and where do we see it going over the next year or so?
Sure. Great question. So back in March, April, had roughly just under 200 million under contract or in marketing in the multifamily space here in St. Louis. And when COVID hit, everything just either blew up or delayed. There, the debt market went completely sideways. You couldn't, if you had a deal that was ready to close, lenders didn't know what to do. And without the debt market there, every deal got pushed out. There was either extensions or, deals fell out of contract. If you weren't hard committed with your lender, rate locked, ready to close within a few days, deals were just getting pushed out. So that was a tough experience when, I wake up every morning with the foot on the gas pedal, and no matter how hard you're pushing, the debt market was like, hey, this deal's not going to get done right now. So that was, an interesting experience, but, call it end of May, early June, the debt market came back and deal volume just took off again. Deals were closing, new deals were coming out, and again, the equity on the sidelines, and now that the debt market's back. So I feel like this year there'll be a big catch-up period. The summer was a big few months of large closings. You had the Barden closing, Clayton, big deal in Wildwood closed, Carriage Place. So there's some big transactions that close, and there's some deals that are under contract that should close before year end that will make up for, call it a first, March, April being slow and delayed. So I expect going forward that sales volume will continue at the same clip from historical years in St. Louis. Call it $500 million plus transaction volume in the St. Louis market should be consistent for the multifamily space.
Yeah, we're definitely seeing an acceleration of equity capital wanting to deploy, not just in this market, but others, as Matt said. I don't know about anybody else, but I got, in a short period of time, got pretty sick of hearing our pencils are down, or our door's closed, but it's not locked. And but now, I know a lot of the equity partners, institutional partners that we work with, are wanting to fill their pipeline for capital to deploy in the first quarter. So.
Yeah, that's great to hear. I remember being on like the first, couple webinars when COVID happened, and we were trying to figure out which way was up. And some of the smartest people in this industry in the country were like, oh, it's going to take 12 to 18 months for price discovery. And it was just like, what? Like, really? So it's great to hear that there's been some big transactions and that you guys predict that it's going to continue.
Pat, did you want to say something?
Yeah, just to coincide with your debt conversation, the debt market was closed but not locked. But they quickly found ways around that in the debt service reserves, the tax and insurance reserves, which they got a lot of feedback on really quickly, and then eliminated. So they were very quick to respond to the demand that's in the market. And I think that Matt touched on, specifically the demand really drives the whole market itself, right? So because there was so much pent up demand, everybody wants debt, and we'll give it to them.
Yeah, and I think everybody was really pleasantly surprised with absorption. In my pre-Clayco CRG days, we developed the Hibernia project and Dogtown Fair project. Both of those were in lease up starting basically in January. And we're 96% leased in Dogtown and about 90% Lafayette Square. So all since January, absorption was a real pleasant surprise for everybody. And I think a lot of lenders and developers were, just the uncertainty of not knowing if people were going to want to move during that time was a pleasant surprise.
There's a huge focus on collections as well. Yeah. And that lease up and that absorption really helped out with the collection numbers, and maintain, like Matt said, 97% collected really helps out.
Yeah, the only properties that we've had in our portfolio across the Midwest where we've had collection issues are LIHTC properties. The Class A new construction properties specifically, people continue to pay their rent. They seem to still have their jobs. They're just working from home.
Yeah, that's a good point. The workforce housing space has taken, a hit in terms of collections. In the Class C space where there's still, eviction protection for residents. There are residents that are struggling, and currently it's very resident friendly. So there are properties where you have collection issues in the workforce housing space, more in the service oriented type of jobs that have been just lost with COVID. So in the LIHTC space, I could see that being more of an issue.
So it sounds like Class A and Class B, B plus is doing well with collections, but we're having maybe some issues with LIHTC and workforce. If this eviction moratorium continues for another 12 months and we don't get any sort of stimulus to assist these folks that are struggling to pay their rent, do you think we're going to see any distress in that particular segment of multi?
We're seeing it. A couple of LIHTC properties or workforce properties that were trying to take to permanent financing, getting debt sized where we thought we could pre-COVID is a problem just because of collections and being able to charge late fees. Many residents are, in a hole that they're not going to be able to dig themselves out of. I doubt there's going to be relief for landlords to collect late fees. Some people are, racking up, 6, 7, 8 months worth of late fees and collections, and you can't evict them. So I think, what I'm seeing personally is on the sizing of my permanent debt, and then the additional reserves that the agencies are requiring can be, I guess, problematic.
So let's go back to the debt conversation, Pat. We talked about how interest rates are at an all-time low. Tell us about the lenders that are in the marketplace and what type of debt are available to borrowers, both on a construction bridge basis and also permanent.
Yeah, there's when COVID first hit, there was a significant pause. The CMBS market actually, I think rates went up 12% for a good while. The agencies have kind of always been in the market, and they were very proactive in their stance on any of the debt market, as far as multifamily especially. They've come down quite a bit on their restrictions since then. Their volumes are actually matched up with their 2019 volumes right now, and they're expected to fill their whole allocation that they were given. So the CMBS market has come back since then. They are actually very strong right now. We just signed up a CMBS deal it's a 3.25 rate. It's probably you know, 75% leveraged, and there again, this was a fight. Don't get me wrong, but there in the last week or so, there was a lot of demand or pent up demand because deals went out to the market and there was so much positive reaction. So I think that they are back in the market right now. As far as bridge and construction lenders, I think that's on a case by case basis, really. That might even be more of a relationship basis for some people. But the CMBS market, the agency side, they're back in right now. They're willing. They need to fill their
time.
So does in terms of deal structure, does your capital stack look different at all, or is it just more equity?
Yeah, a lot more equity. That's a lot more equity for sure, and simple deal structures. I mean, where we may looked at deals that would have multiple layers of the capital stack pre-COVID. I mean, pretty simple deals now where 50 to 55% loan to cost deals, and being willing to accept LIBOR floors and things like that weren't around pre-COVID. But again, as we talked about, I mean, with interest rates as low as they are, I mean, we've been able to get, we've narrowed our focus a little bit on return on cost too. I mean, deals that when we would want to pencil at 6.5 or 7, whatever that number was for people, as we've seen cap rates drop precipitously. I mean, I don't know, have we had any four handle trades yet?
It's getting there.
It's getting there. Yeah. So the margins that we're underwriting to are, you can get away with, 100 to 150 basis point margin on your return on cost to cap rates. When you're going from, I'd just as assume go from a 6 cap to a 4.75 as an 8 cap to a 6. I mean, the percentage change is essentially the same. So, deal structure, simple deals, a lot of equity, I think can still get done.
Pat, what about the HUD market? I'm hearing from sponsors and borrowers, the HUD market's in the 2s when it comes to rates. So
yeah, that's right. The HUD market really never went away. They didn't really pause. If you're willing to put in the effort with HUD, you're sitting 2.2 right now, and it's a great market. They were almost built for this type of market situation, and they've gone strong. I know Berkadia's production volume on HUD has, I think, crossed $2 billion right now, and it's one of the strongest years they've ever had.
Yeah, you're getting the low 2 rate, and you're getting 80% leverage on top of that. So,
and the reserve requirements aren't as onerous anymore compared to Fannie and Freddie, since they've raised their reserve requirements.
How long does a HUD execution take at this point in time?
So HUD is backed up. This is a tricky question. No. Typically, they say 6 to 9 months for a cash out refinance. You can kind of gauge that a little bit, it'd probably be more of 7 to 10. Switched it off. There are certain streamline refinances that go a little bit closer to that, but I think that time frame is kind of a general guideline for you.
So Jeff, going back to new construction, new development, let's talk a little bit about COVID impact on labor costs, supply chain. Can you tell us how that's been impacted over the last 7 months or so?
Yeah, I mean, I think, early on, everybody was, really scared about the supply chain. Candidly, of the 8 projects that multifamily projects that we have going on right now, I've had one supply chain issue. It's with a cabinet manufacturer out of Vietnam, and it wasn't the manufacturer. It was, the West Coast ports are much more locked up than the East Coast ports right now. Nobody really thought about kind of what ports were going to be busy and are containers going to be available, and are they going to ship on rail, or how are they going to get from the port to Kansas City or St. Louis or wherever. Those are things now we're like, wow, that it certainly makes sense in hindsight. But we've only had one problem on supply chain. I think there's enough suppliers out there that we made some decisions, things like whether on our Wild Horse project in Chesterfield, we switched up some stone where somebody had a similar stone in stock that we knew we could get, and we just didn't want to take the risk. So I think the more savvy general contractors, we were trying to be proactive about those type of things. We haven't really had any problems on supply chain that we thought we would have. And cost, I mean, I think, initially there was some shocking cost. The uncertainty, people just didn't know. But everything seems to be stabilized. Lumber market's all over the place right now, but other than that, I haven't had any issues.
Yeah, I've heard from developers lumber's been a big wild card right now. So we're trying to pencil a deal and get going on a project today. Lumber's doubled, from where it was a few months ago. The other item that I'm hearing is a big, difficult to get is washer dryers on the multifamily side. People have ordered washer dryers, paid for it, supposed to arrive, it's just not there. And people are scrambling. Not only for new construction on washer dryers, but existing product breaks, replace it. Washer dryers are on a backlog. So lumber on the new construction's been the big wild card, and on existing product, it's been washer dryers, is what I'm hearing.
Yeah, I mean, appliances in general, we've also had issues with condensing units. It was really tough during June and July, during peak AC season. And I mentioned this to you guys the other day, but we would buy something from our supplier. It would be at the shop. We'd be waiting for delivery or to pick it up. And then a different salesperson would sell it to one of their accounts. And, we were stuck waiting for another week. So it's just, it was a major challenge. I think we're mostly past that now, but yeah, it made for a tough summer for sure. Sticking with development, do we see COVID impacting multifamily design in the future? Are buildings going to look different? Are we going to have maybe some new amenities that we didn't have pre-COVID?
Yeah, it's interesting. I mean, there's a lot of discussions going on. There's this kind of, a lot of people want to talk about kind of a suburban move out to the suburbs again, but still seeing demand, and we're not having any rent issues, absorption issues in the urban areas that we're in. I think there's also a lot of talk about units getting a little bit larger. If people are going to work from home or having, a little bit different type of amenity space. But, I think I don't really see many major design changes right now.
Yeah. I sold a deal in West County 2 years ago that when we were touring with investors were, laughing at the developer put a built-in desk into the wall, and I remember this from 2 years ago. We were on tours, like, why would he build an office like desk into the wall? And now today developers are saying, well, for these new units, we're going to figure out a workspace area because everyone's working from home. So like, it's funny how something 2 years ago, investors were critiquing on why would someone do that? And here we are today. A lot of owners and developers are thinking of, with people working from home, what kind of workspace area can they build in? Can amenities space be turned into more of a work from the development type of area as well? So I think those things, you are hearing the push to suburban product. I mean, if in the Wall Street Journal, there was articles about New York City and San Francisco being at their lowest, in terms of their highest vacancy rate in 15, 20 years. So there has been a big push from tier one markets, people leaving to get closer to their family if they're able to work remote. And the secondary markets have been a big beneficiary of that. So you're seeing a lot of people. One of my clients from New York runs the Midwest for a big real estate fund. His family's from St. Louis. He's been in New York for 10 years. Called me 2 months ago. He's like, permanently moved back to St. Louis, and he's like, the house that I bought, my mortgage payment is less than the rent I was paying on a 1-bedroom apartment. So you're seeing a lot of that shift from primary markets to back here to secondary markets. But in terms of design, I think the office, the community aspect of just more amenities for people to get out of their unit and just be able to just be at the property.
Yeah, I would agree with that completely. It seems like this whole hub and spoke office model is really here to stay, where you're going to have maybe a percentage that work in the corporate headquarters and then everybody else is working remote. And I really think multi is well positioned to be the spoke, so to speak. I mean, we're putting community workspace in almost all of our deals now, just providing a place to sit down, plug in, free Wi-Fi, a printer, and at least you can get out of your unit for a couple hours. And maybe you can't use it right now during COVID, but once people are out and about and more willing to be in open space, community space, then I think it's going to be in high demand.
Yeah, and even with interest rates to buy homes at all-time lows as well, people want the optionality of being able to pick up and move. I don't remember the exact statistics, but there's some compelling statistics out there about how many people made major city moves since March 1st till now. And so although people are willing to pay more in rent than maybe they would on a mortgage payment, so they can have that optionality to move, waiting. If there is something else that happens, maybe we want to move to Albuquerque or wherever they want to move to.
Right.
So it kind of dovetails into the next conversation. And also, we talked a little bit about people moving to the suburbs. So, I mean, we see headlines about, everybody wanting to move to more space. If you're accustomed to an urban setting and you want to take advantage of restaurants and bars and parks and all the great things that an urban environment has, how long are you going to potentially stay in the suburbs? So do we think that there's going to be an overall shift to the suburbs, or is this just a real short-term trend here that we think is going to come back pretty quickly once the percentages of people allowed in bars, restaurants, et cetera, go back to what they were?
Yeah, I'll start. I mean, obviously, we're making a massive investment in Chesterfield. We'll have $500 million invested there behind the mall when all's said and done here over the next couple of years. And then right next door to Steinberg's Chesterfield Mall development, which is in the planning stage. I think thematically we feel like master plan developments in the suburbs are going to do really well, where you can provide the other types of activities. But in the urban areas, around job centers, I think people will continue to congregate around the job centers. It's just a matter of when and if people go back to work. Downtown St. Louis is a ghost town right now. I was down there Tuesday morning. I couldn't believe it. But other areas in the, look at, 100 Kings Highway is leasing up fantastically from what I hear. You're around great employment base there next to the hospital and near Cortex and WashU and what have you. leasing's continued to be strong in the urban areas, but I think a lot of it's driven by the capital. It's a much easier story for the capital providers to tell their investment committees that, hey, we're allocating this amount of money into the suburbs right now, just because it's an easier story to tell.
That and I mean, as a resident, there's going to be residents that are attracted to walkability of urban deals. That won't change. So there's going to be residents that want, to walk to restaurants, walk to the park, walk to, their job base. And people that want walkability, it's tough to replace that in the suburbs. If you want to go to eat, you're going to get in your car. It's just a renter choice of living in a more urban setting or a suburban setting. A few years ago, it was all urban. You go to every conference, and urban's, the hottest asset class, and cap rates on urban are 50 basis points lower than suburban. And now in my opinion, they're about equal. So I don't think suburban's more sought after than urban. I just think they're much more comparable in terms of investor appetite right now. I do think, though, that, hopefully once we get back into a normal routine and, COVID's of the past, I do think that urban will come back again strong, just because, again, the whole points of walkability and amenities, and people always want to live close to their jobs. That's a big reason why developers choose urban, is, the aspect of work, live, and play.
Pat, when you guys are looking at it, to urban versus suburban, or is a good deal a good deal?
Well, the heavily focused on deals right now is collections, right? It doesn't matter if it's urban or suburban. If people are paying, it's a good deal. And the agencies and other lenders recognize that. As far as trending wise, they go out and say, is this based on circumstances of the now, right? And is it, if the circumstances change back to where they were, are they going to see an increase in value? Lenders really aren't looking at that type of viewpoint of the value. That would be more kind of the investors. But a good deal is a good deal for these guys. And like I said, the debt markets are back open. They are willing to place money. They need to place money.
Yeah, the last point on the suburban urban trend, what I am seeing from, very forward-thinking developers is they're creating a urban suburban setting in the county in St. Charles.
I heard somebody say it was called Surban.
Surban, there you go. Yeah, and that's very popular. So you look at the streets of St. Charles, right? It has a very urban feel in St. Charles. You look at what Jeff's doing. You have the live, work, and play. You have luxury apartments. You have restaurants. You have a Ruth's Chris Steakhouse. You have other amenities that makes it feel like an urban setting.
Sounds like he's getting ready to sell it for me.
Here's the listing agreement. Just sold a deal back in July at the Meadows in Lake St. Louis. There was a developer out of Arkansas built a 220 unit deal right at the front of the Meadows Shopping Center, and that created a very urban suburban feel for the residents. So the resident there could walk to numerous shops, numerous restaurants, didn't have to get in their car. So that is, if I'm a developer, that's what I'm forward thinking of going into the county. How can you create a similar experience to that?
So we've talked a lot about collections. Obviously, they've always been important. Never more so than today. But obviously, we need jobs, and we need good paying jobs for these tenants to pay. So what do we predict St. Louis's job story is going to be over the next 12 to 24 months?
Interested to hear the next panel from the office market, but from what it seems like, again, just looking at collections, remains healthy. So that's the best indicator from a multifamily space is, are people paying rent? Are owners able to push rents on renewals? Are owners hitting their market rents on development deals when they're going through their lease up and absorption? Those are sort of the three check boxes I'm looking at. What are renewals looking like? What are new leases? How's absorption? If those things are all moving in the right direction, that makes me feel good that the job market is also holding up. So that's probably as good of a forecast from a multifamily perspective on what the office market's doing. Pat, do you agree when you're underwriting these, or?
Yeah, I agree. The only one I would slightly modify is there's a lot less confidence in rent increases right now.
Yeah.
If you're planning to sell a deal based on rent increases, the lender might not like that type of
Underwriting.
Yeah.
Yeah, I think there'll be, a lot of the properties that'll be going to market, there'll be some scrutiny on what the concessions were during absorption as well. Modeling deals now with untrended rents for 5 years is kind of standard, I'd say, post-COVID, but as well, taking a look at, one of the reasons we decided to not sell Hibernia and Georgian is we took a pretty aggressive approach early on in lease up and in COVID to get aggressive on concessions, thinking, hey, we don't mind owning these properties for a long period of time. We just wanted to get them filled and felt like the properties were compelling enough that we could keep people there and we wouldn't have higher turnover. But I think, a number of other developers that I'm talking to who are trying to take things to market are definitely concerned as to what they had to do during lease up on concessions and how their rent increases were modeled.
Yeah.
When you guys are looking at concessions, are you looking at the same or a better structure in terms of like month on the front end, back end, amortizing over the across the entire lease term?
So we kind of look at all concessions the same way. The only thing that might be different now are COVID concessions. Those would probably not be favorably received because it would indicate that there might be a renter payment problem in the future. Another thing that we kind of look at is if the property itself received any PPP funds and how that affects payroll. So you kind of have to group all of these relief programs together and kind of check the boxes when you're going through it.
From an underwriting standpoint, on an investment sales perspective, I prefer when developers or owners do a front-end concession, not a ongoing concession or a back-end concession. The reason why I like a front-end concession, and what I mean by front-end, let's say you have a resident that's going to move in, you give them 1 month upfront for a 13-month lease versus saying, we'll do a 13-month lease and spread that discount over the course of your lease. The front end is better for your value of the asset because hopefully, in month 4, 5, 6 of their lease, they're used to paying market rent, and the value of the asset is now capped off of a market rent, not a discounted ongoing concession rent. And the goal, similar to what Jeff said, is once that lease renews, instead of trying to take them from a lower rent to market, they're already at market, and hopefully they stay there. So from a value perspective, I prefer an upfront concession versus an ongoing or back-end concession.
Yeah, not sure I want to share this, but I utilize Matt quite a bit early on pre-development as we're building our models. We'll sit down with Matt, talk about lease up, not just like unit mix and pricing, but how do we model concessions? What should we be doing now, even before we start construction? It's kind of one of our secrets to bring in guys like Matt who understands what people are willing to pay for in the future and how we can create value early on. But I think that's critical for sure.
And then lastly, we've talked about how the tier 1 MSAs are struggling right now, and these lower cost tier 2 cities like St. Louis are looking much more appealing to folks that traditionally live in New York, Chicago, LA. But how does St. Louis compare to our tier 2 competitors such as the city, Cincinnati, other Midwestern Rust Belt cities?
So in general, the Midwest is held up extremely well, on all the different, we have bi-weekly calls with all the different multifamily professionals in all the different Midwest markets. And on every call I'm hearing collections are great, investment activity is, the amount of equity chasing deals in, other markets is at record levels. So fundamentals in the Midwest are as good as it gets, really. In St. Louis, I would say that when we compare our pipeline of new construction, we're still very low in terms of the unit count compared to our population, our MSA of 2.8 million compared to other markets. You look at, again, Kansas City's 2.2 million in MSA, and they're producing 4,000 to 5,000 units a year consistently. We're at 2.8 million. We're, call it 1,800 to 1,200 on a good year when it comes to new construction counts. And if you look at us today, I could count probably on one hand, maybe both hands, what I think are real projects that are about to go out of the ground. So when you look at our forward pipeline, it's very minimal. I feel like there could be more projects, but again, it goes back to the difficulty of finding sites, getting zoning and entitlements approved here. Construction costs are on the rise, making deals pencil out. So I think that the fundamentals in St. Louis, with how strong our occupancy is, with how low our construction count is on forward deals, the fundamentals here will remain extremely favorable for the coming years. Like if we got in a car today and you're like, hey, let's go find a site, I wouldn't know where to find a site.
Yeah, we've talked about this a lot. We're really active in Indianapolis and Cincinnati, Kansas City, and we started making a decision in 2015 to rotate heavily into St. Louis just because of, we felt like the forecasted deliveries here were way below what should be in some certain submarkets like Chesterfield, where ourselves, the Watermark guys, MLP, we felt that market was underserved by probably 2,000 units currently. That's why I think you're seeing such a big new development push there. Plus, nothing new had been delivered there in 25, 30 years. How many times can you value add Shetler Village? Before it needs to be torn down. But the other thing I think that's, although St. Louis has its problems, the institutional quality, institutional size assets that have more predictability on real estate taxes compared to some other MSAs. Try to get a new deal done in Chicago right now, where there's so much uncertainty on real estate taxes. It's going to be really tough to find, again, a buyer to buy an institutional size, institutional quality asset with uncertainty around real estate taxes. So either the deal needs to have some type of fixed abatement or developer-owned TIF that functions like an abatement, or you need to be in a municipality that you have some predictability. It's not just about having no taxes on a property. It's just certainty and predictability over the next 10-year holding period.
Yeah. And the activity from investors in terms of the amount of always gives a feel on, how well the market, St. Louis, how we compare. I mean, I'm seeing on every deal that goes live to market, seeing over 100 CAs signed. I mean, that shows how sought after the St. Louis market is. And a lot of it's for the stability of the.
And what percentage are out of town institutional buyers?
Of the deals that have closed, call it the last, let's go back to 2010, I would say roughly 90%, if not more, are out of town buyers coming to the St. Louis market looking for stability, good cash on cash returns, and, the strength of that out of town capital pool that keeps chasing St. Louis. Always, that gives me a good gauge on where we at in terms of a market. And, we're seeing 10 plus offers on deals, very competitive, first round, best and final type of process where sellers are really getting premium pricing and, out of town money is really looking favorable on St. Louis. So that's a good gauge.
As far as yields go in St. Louis, I mean, given the scarcity of product that's been developed over this cycle, you would assume that yields are going to be lower in St. Louis, but I don't think that's the case. Can you guys expand on that at all when you're looking at, or at least from a cap rate perspective, St. Louis versus some of the other tier twos?
Yeah, I mean, we've had sub 5 cap trades in Indianapolis in suburban and urban product, Class A, new construction. Same with Cincinnati and same with Kansas City. Again, I think maybe we'll get one here towards the end of this year or early next year in St. Louis. It'd be interesting to see like how Watermark's property trades out in Chesterfield. But yeah, I mean, there's still, I think, a discount to St. Louis, again, based off of, Indy, Cincinnati, Kansas City, where we've already had, 4.5 caps in all three of those markets.
Yeah, I mean, on a call last week from, we had a panel of buyers, 4.5 caps becoming the new norm for trades in the Midwest for newer multifamily. And in St. Louis, we're at the low fives right now. So I do think we'll break into that threshold, but from groups trying to place equity, that's becoming their new norm on underwriting is we got to be in the fours to win a deal in today's market.
You got to break, and as a market, we got to break down that perception that that's too low. I mean, if these institutional buyers, their cost of capital is probably even lower than 2.5%. I mean, so if they're buying a property at a 4.5 cap and putting 2% debt on it over the next 10 years, it's a screaming cash on cash return for them.
Okay. Those are all my questions for you guys. Ernie, how much time do we have up here? Do we have any time for questions from the audience? Sure.
We've got an online question. Oh, go ahead.
What was that? Say it one more time. So the spread between interest rates and cap rates.
So so Matt's targeting, he said low fives, right?
Yeah.
In today's world, an agency deal will probably be around 310. So,
200 basis points.
yeah, I mean, almost 200 basis points.
And that's on Class A institutional deals. I think he was also curious about what's going on in kind of the Class B market.
Yeah. So
based on cap rates.
Yeah. So in the Class A space, you're seeing, low fives, and in the Class B, you're seeing upper fives. It's still, so, a 1980s deal, let's say in South County is going to trade in the upper fives in today's markets because the debt's still low threes on a Fannie Freddie execution. So, yeah, I would say it's roughly called, if you're looking at like what's the spread between the interest rates. So on Class A, 200 basis points. On Class B, call it 250 to 275 basis point spread on the cap rate versus interest rate that you're going to get. But I see more people focused on what's the year one cash on cash return as the main driver versus, what's the spread between the cap rate and the mortgage.
Where would you say hard costs are today for the 3-story walk-ups? You said lumber is doubled. What are you projecting now for a new project out of the ground on hard costs?
You got any bids recently?
Yeah, we don't do any like slab on grade 3-story walk-up stuff, so I'm probably not the best person to ask. But I do know, exit values. I have no doubt Watermark will trade over $300,000 a door. So if you can build it for $200,000 a door and sell it for $300,000 a door 2 years later, you're doing pretty good as a developer.
Pat, do you hear any cost from? And I could give my opinion, but
Yeah, I can't really pin down a number for you from an increase standpoint.
yeah, from what I'm seeing, a deal that would have cost like a 3-story walk-up product, let's say a year or two ago, you might have been able to build. Okay, let's just do the whole equation. So for a suburban garden style deal, developers want to be in the land for, let's say, 12 to 20,000 a unit for a walk-up product. So let's choose 20,000 a unit in today's market for dirt price. You're probably looking at 120 a door for construction costs in today's market, given the lumber price increase, and then soft cost tack on another 10. So you're probably looking at about 150 a door in today's market to build, high quality walk-up product.
And developers are making other cuts to make up for the lumber costs. I mean, you're seeing LVT go throughout the entire apartment, or other decisions that you're willing to make up for the increase in lumber costs. Yeah, so I think 150 a door is probably pretty realistic.
I think that's a give or take. That also depends if you're going union or non-union too, in terms of construction. So I'd say plus or minus 10 to 15,000 a door, depending if you could get some non-union trades or if you're having to go all union, would be a good ballpark all-in number.
Here's an online question. We talked about the St. Louis region, however, we're really talking about the white area region. My question is, what is needed to get development in the other parts of the region, African American?
Yeah, so that's really, if you're trying to build a deal, in the North County or more workforce housing submarkets of St. Louis, you're going to need incentives to make the construction cost pencil out. So whether it's a tax abatement, whether it's tax credits, whether it's TIF, because construction, it's a math equation for a developer when they're building out construction cost. They need a certain rent to be able to make the numbers pencil out, both from whether a deal pencils out on their model or on the lender model. So, there has been some tax credit projects that are going into North County. And it's really incentive driven. You have the opportunity zone capital that continues to chase deals in the St. Louis market. I think there'll be more opportunity zone developments. I know 2 or 3 developers that have deals under contract that will be multifamily driven in opportunity zones in the city. And then when NGA gets open, there's a lot of buzz on, new housing that's going to be developed around the NGA as well. So I do think those some markets of workforce housing will continue to thrive as well, but they are very incentive driven to make the numbers pencil out. Have you looked at any?
Well, yeah, and I mean, just urban areas in general. I mean, public-private partnerships, figuring out other levels of the capital stack to make them work. I mean, our project at DeBalver and Pershing, has a significant amount of TIF and CID in partnership with Bi-State. But, I think in any urban environment, safety is paramount. And in the city of if it's in the city of St. Louis, there hasn't been, it was great to see, really refreshing to see yesterday that this potential mega merger of these civic organizations, but having strong leadership at the public level to give developers a little more confidence that this is worthwhile 10-year investment is I think really important.
Any other questions online? We're good. Good. Any other questions from the audience? Great job. Thank you very much. introductions. Take it from there. Thank you.
Thank you. My name is Dean Burns. I'm with Gundaker Commercial Group. We have some of the best professionals in the business up on this podium. I know better. I think there's this whole underlying current in our industry that is anecdotal. Things are happening that aren't being reported. So I'd like these gentlemen to tell us the truth about what's going on in the market. Okay. First of all, I'm going to introduce Sheldon Johnson. Sheldon's with the Johnson's Group, family-owned business, and Sheldon's a SIOR professional, been at it for a while. Tell us about the industrial market in St. Louis.
Hello, is this on? Okay. I'm Sheldon Johnson, as he indicated, and I'm with Johnson Group, and in the business 39 years. And talking about the industrial segment, first off, we need to know that St. Louis metro area is now approaching 255 million square feet of inventory with the construction underway. And the current vacancy rate is about 5.4% with the new construction that's going to be completed this year. At mid-year, the unemployment in St. Louis is at about 11.5% compared to the national average of 13.3%. And I'll be covering 5 topics today. First, current trends, the hot submarkets for new construction, major lease deals, sales activity, and what my predictions are for the next 12 months. Starting with trends, the third quarter of 2020 is the 26th consecutive positive absorption in the St. Louis metropolitan area. Absorption should match last year's 4.2 million square feet, but could surpass it with the current e-commerce activity. New construction of build-to-suit activity is increasing across the market, and construction of spec space is pretty steady. Rental rates are pretty stable with all the new inventory come online, but slightly lower to maybe 1% at certain peaks, which is about 5 cents a square foot. Although we're seeing in the Metro East about a 4% growth in rents, and they're up to almost $4 a foot, triple net. Of course, activity is increasing with e-commerce as more consumers buy on the internet, especially now with food due to the impact of COVID. On the user side, there's very strong demand for buildings 10 to 100,000 feet in all submarkets, and that's driving up sales prices. There's a supply shortage for user buildings of almost any size in any market. On the construction side, costs are rising quite a bit, and that's due to a shortage of sites, current MSD regulations with the Clean Water Act, new IBC code requirements in municipalities, and all those things are impacting our costs. They're driving up costs to over $100 a foot for your average industrial building. Tax abated developments have a competitive advantage over with lower triple net charges compared to older inventory and non-abated projects. So next I'll talk about the hot markets for new construction. There are really 4 areas that are seeing this. St. Charles County, the Medline Medical Services is doing an 811,000 foot build to suit. Cosmos Corporation's doing 240,000 feet. Central States Manufacturing, 53,000 foot build to suit at 9001 Premier Parkway. On the Metro East side, Exeter just completed 674,000 feet at Inner Park and has several 200 to 400,000 foot prospects. And they have a pad-ready site. They could build another 800 to 1 million square feet as soon as they sign a couple leases in the first phase. Panattoni just completed 750,000 feet 2 months ago in Lakeview, and it's already 50% pre-leased. Moving over to North County, Arthur Express did a 65,000 foot build-to-suit in Park 370. And in Aviator Business Park, Panattoni completed a 415,000 foot spec building, number 9, and has a building number 8 of 222,000 feet of spec ready to go. Also in Tradeport, North Point continues to build new state-of-the-art product. So North County is really healthy. The other hot market is down in Fenton, which has the highest rents in St. Louis and the highest sales per square foot on building trades. Of course, Fenton Logistics Center replaced the old Chrysler plant. They have a 190,000 foot spec building going and a 182,000 foot spec building that ended up being 100% leased. And they're ready to build more product with their success there. In terms of major leases, we couldn't talk about the lease market without talking about the 800-pound gorilla, Amazon. They just leased about 1.1 million square feet in the Metro East in 2 projects in Gateway and Gateway Tradeport, each over 500,000 square feet. Worldwide Technology renewed their 1.1 million square foot lease in Lakeview in the Metro East. Lowell's Home Centers renewed a 673,000 foot facility on East Gateway. And over in St. Charles, Distribution Management took 375,000 feet at 1001 Premier Parkway, and National Tire Wholesale took 7. Moving over to North County, Forte Frozen took 269,000 feet on North Hanley, and Leonardo DRS took 172,000 feet on North Lindbergh. And Basque Services, a Boeing 3PL, leased 205,000 feet in North Point's McDonald Boulevard building, taking the whole building that was built spec. Elite Printing took 125,000 feet at Tradeport in North County. And as I mentioned earlier, First Farm took the spec building in Fenton's Logistics Center, 182,000 feet. Moving next to the sales activity, which has been robust. Institutional investors have a lot of capital to deploy, and they've moved into the Midwest activity in our market. And kind of closing out now, I'll talk about my predictions. First off, let's talk about expect strong demand in bulk supplied by e-commerce and last mile delivery. Stable rents in new product, but to keep decreasing rates in flex space, which is challenged much like office. Increasing sales price for user buildings, mainly for manufacturing firms that are increasing their activity. Steady lease rates in older inventory in South, Mid, and West County, but a slight downward pressure in the North County and St. Louis City inventory for older product. More build-to-suit activity, especially in St. Charles County in Illinois, where sites are readily available. And in St. Louis County, Maryland Heights may become the next logical spot for zoned industrial sites. And on the sales side, increasing sales prices with cap rates approaching the low fives for institutional quality properties, as buyers have really arrived in St. Louis now. That completes my industrial overview, and back to you, Dean.
Thank you, Sheldon. We'll take questions at the end of everybody's presentation. Now I'd like to introduce Alfredo Gutierrez. He is the president and founder of Sparrowhawk, which is an industrial investment firm in St. Louis and throughout the U.S. Alfredo.
Thank you. And thank you for inviting me again to join y'all on the panel this year again. And Todd, it's good to see you in person as opposed to on a computer. Anyhow, as already been indicated, investment sales in St. Louis in particular, and some of the other secondary markets has really escalated. You know, going into the COVID end of 2019, early 2020, you're already seeing institutional investors realizing that the second tier cities and not just the gateway cities had a place in their portfolio, and they were looking at and investing in those markets. St. Louis was one of them. St. Louis was trending a smidge behind some of the other cities, as the previous panel indicated on apartments: Cincinnati, Columbus, Indianapolis, Louisville. But it continued trending down in cap rates and increasing in price per square foot, and development continued to grow. Positive absorption continued to exist, and those were all good attributes for any investor. COVID hit, and what happened in investment sales was it kind of dried up a little bit. There was uncertainty from lenders and, to some regard, investors as to what impact this would have. It was quickly realized that the effect on industrial was going to be marginal, if at all anything. And you began to see single tenant buildings trade, not to the level they were trading in 2019, but there was still an appetite for it, and cap rates continued to compress. And there was scuttlebutt, because nothing ever traded there, that cap rates may have moved 25, maybe 50 basis points higher on some of the multi-tenant product or some of the smaller product. As we have seen over the last 45, 60 days, activity level as far as marketing goes from the brokerage houses has boomed. I can't, focus on the number of deals that are coming across my desk. That's the volume that's coming, and more coming every day. And what I'm seeing is it is trending down in cap rates, and as already indicated, pricing is going up, and in particular in this city and some of the other secondary cities, but in this city more so than some of the other secondary cities, because there was a gap already between where St. Louis was trading and where Cincinnati, Columbus, Indianapolis was trading. All those were trading at a small discount to the regional hub, which is Chicago in this area, where St. Louis was trading at 50, maybe 75 basis points higher. So you're seeing a compression. That's here to stay. The Fed has already indicated that rates aren't going to move. They've already said that they're going to keep Fed funds rate probably flat for the next couple of years. I predict it's for the next 7 to 10 years. And the reason I predict that is if you look at the trend, what happened after the Great Recession and the pandemic, you could argue that some of the economic numbers in the Great Pandemic are worse than the Great Recession, the financial recession, on unemployment and some of those other factors. The Fed funds stayed flat for 7 years after we came out of the financial recession. There's a much bigger impact to unemployment and the image of what occurred during the COVID pandemic. I believe the Feds are going to keep that fund lower than 7 years. It could be 10 years. So in the near future, we're at low interest rates. That's not all good, because what is happening is, as already been indicated, cap rates are coming down. Yes, your debt is low, which is positive, but the coverage that the life companies are wanting to have on their debt is getting to be a challenge. And so where you could probably push in 2019, 65, and if you really tried, you probably could get 70 out of some of these life companies. They're really holding it now to 60. They don't want to get to 65 because of the coverage. They don't have the multiples that they have on their coverage at those aggressive cap rates. So what that means is more equity's coming in. The good news is in industrial, there's a lot of dry powder out there. We're seeing guys that were investing in office and retail choosing industrial. And they're only choosing it because the fundamentals are sound. They're choosing it because it is beginning to be a product type that they understand and they aren't necessarily embarrassed about. As I always joked with my wife, she says, "Why'd you pick industrial?" I said, "Well, I'm not pretty enough to sit in front of an office and get my picture taken with that beautiful building. So I'm going to be over in industrial where they never take any pictures." And so, that's what the investors were looking at. They could get an office building and they said, it's pretty, it's glamorous, everybody gets it. Industrial, that's a garage, it's a cement box. Why would I ever want to invest in that? I don't get that. But they're now starting to understand the fundamentals in it. And not only that, thanks to, Big Smiley, Amazon, everybody gets it. And they all think industrial is Amazon, which is, as we all know, false. E-commerce is about, 20% of the retail sales. At the end of 2019, depending on who you read, it was around 14, 15% of retail sales was e-commerce. Amazon is about 20 to 25% of e-commerce. So if you do those numbers, you're like, well, Amazon's really not industrial. It is part of industrial, but it is not industrial. The advantage is they've been growing like crazy, putting up 2 or 3 boxes in each market. As we already indicated here, two big boxes have come into this market. And the reason they're doing that is they're realizing with going from the just in time concept to the just in case concept, which was easily understandable to the common person by saying, could you find toilet paper during the pandemic? They get disruption in supply chains. That's all you need to tell them. That existed, but it existed in a lot of products. So what they're seeing is we still need the gateway distribution point, which is Chicago in this part of the market, or Dallas to lesser extent. They still need that. But you also need some decent sized boxes closer to the population. That's what Amazon's doing. That's what all the other big box retailers are doing. And it's amazing to look at the numbers. I mean, e-commerce during the pandemic went up by over 200%. So we went from 15% to 35, maybe 40%. It is settling back down, but it's still going to be much higher than the great acceleration we were having pre-pandemic. It'll settle down to be north of 20%, which is phenomenal. That's over $1 trillion of commerce. That's a big number. And you look at the folks that are really benefiting from it, which Amazon is, but Amazon's not. Target's sales have tripled. They've gone up 295% in the second quarter of this year. 295, they tripled. That far exceeds all what their retail boxes were doing. Walmart is about 150%. So those guys don't get the press that, Amazon gets, but they're booming and they're putting boxes on the ground. And what I'm seeing is there's been a tremendous growth in that, call it 200 to 400,000 square foot box. That box is bread and butter in this town. And you no longer hear the brokers talking about, well, are we oversupplied? Are we overdeveloping in East St. Louis and Gateway Commerce? I mean, look at all the product coming out of the ground. Are we really going to be able to absorb that? To, wow, are we going to be able to put enough product back on the ground? And they're filling up. I'm seeing more activity, seeing more decisions being made by tenants than I have in the past. RFPs are going much faster than they were as opposed to, you're following up for months on end. Deals are being done. We're executing leases. I executed a lease, which I'm upset that you didn't mention our lease over in Park 370 to Legacy Pharmaceutical. But we did that deal in about 2 weeks from serious discussion to lease execution. That can occur. I mean, and fortunately, we got you've got a lot of, to give props to one of my competitors. North Point does a phenomenal job of that also. So the brokers are realizing that they're moving product quickly and getting deals done. So why do I see, in my opinion, this occurring? I think, as we've all mentioned, and I've mentioned previously, e-commerce is growing. E-commerce is here to stay. But the fact that we're going to this increase in inventory, not just because of the just in case philosophy, which if you talk to corporate America, they're saying we need to add somewhere between 5 and 10% inventory. 5 to 10%, you have no inventory left in this city. You have no inventory in the United States because it was sitting at just under 7% in the last reports. So there isn't enough product to do that. But number two, as corporate America goes to, well, we want to still have a mega regional distribution point, and that box is getting bigger. We still need to have, product that flows to the communities closer into the metropolitans, and that box needs to be bigger than it used to be. So that box maybe used to be 100,000 square feet. It's going to 200,000 square feet. But the problem is, every time you put a box on the ground for a tenant or a client, there's a redundancy. So there's now inventory that's being held there. They used to be held in the regional distribution hub, which still has that inventory, but you got to have a redundancy, and it's a multiple of about 30%. So the fact that they're saying we need more inventory, that I believe, but I don't think they factored into we're putting more boxes on the ground, and there's going to be redundancy, which is going to multiply that need for extra inventory. Those are exciting things. What else is exciting to me as an investor, and it should be to you guys in this city, is a lot of that reshoring or probably nearshoring is going to be going into Mexico. And it's if it's not going to Mexico and it's staying in Asia, it's coming out of China and going to some of the other Asian countries. So what does that mean? If it's going to another Asian country, it's probably be coming through the Suez Canal, excluding any sort of wars or political disruption in that area. It's going to come through the Suez Canal. It's going to be hitting the East Coast. That's going to eventually flow over here to get to a distribution point to mass population, not just here, but throughout the Midwest. If it's going to Mexico, it's coming right up the gut. And Dallas is going to be a benefactor. Chicago is going to be a benefactor as a regional distribution point. And everything around both of those cities is going to be a benefactor, which St. Louis is. So I'm seeing all this conversion, e-commerce growing, inventory growing, manufacturing coming to where they're going to be putting product in the middle of the country. It's no longer to be distributed off the West Coast and the East Coast. It's going to sit in the middle because we're a consumer country, and that's where it needs to be. So, you know, to me, I'm very optimistic on it. I'm also excited, speaking about St. Louis, to see some of the new names that are coming in here and investing. You know, group out of Minneapolis is buying the Pepsi building that we just mentioned a second ago. You know, Plymouth, you know, has been in the market here, but you know they're getting a little bit more aggressive here. You're seeing, you know, Sealy come back into the market after selling off. I mean, that's all positive stuff, and you're seeing new names. As an owner, boy, that just, you know, really tickles my fancy. As a buyer, yeah, it sure is making it a challenge, because as the previous panel indicated, the cost of equity and capital to some of these larger institutions, and I was talking to my friends over at Prologis, and I said, yeah, just out of curiosity, what's your cost of funds for deals? And they said about 2%. 2%. So, well, geez, if I had 2%, I could be buying all kinds of stuff. I don't have 2% dough. And so, you know, it's getting to be a challenge for individuals like me to find opportunities, to invest in opportunities as those cap rates continue to compress. It is very difficult for me to get into the fives. I don't see getting into the fours anytime soon, but maybe you do. I don't, but even in the fives, I don't have the money stack that makes that work. Again, I'm not saying I don't like to see it there because I'm an owner. I like to see it there because that means I'm making a profit. The headwinds that we've got, and not just in this city, but more so in Chicago, as y'all mentioned earlier, is taxes. We still have some municipalities that have incentives that they're working with existing developers on. I don't think those taxes are going to be as important if we have the rent inflation that I think we're going to have. It hadn't been abundant yet. It's stayed relatively flat, although there are pockets in some submarkets where you've seen it get some footing under it, but it has stabilized, and you're not seeing as much free rent being given away, and you're seeing the owners hold their face rate a lot more. So those are all positive things, but we haven't seen the rent inflation. I think when you see rent inflation, the developers can afford, can justify, and get the returns they need to get for the risks they're taking without having the extra incentive from the taxing authorities. Why do I say that's important is I think, and it's probably more so in some of the major urban areas, that the cities, counties, states aren't getting the sales tax they used to get. They're not getting some of the taxes from hotels, all those things that COVID shut down. and that puts pressure on their budgets. And the easy deal is always to hit the real estate guys. And so they're going to hit us. And so how much they hit us in order to not adversely affect our tenants is left to be said. But I know we got to cut it off. So I appreciate y'all's time.
Good, thank you. Industrial's looking pretty good. Zach? Zach Williams is with Newmark Grubb, and his specialty is retail. And we're going to talk about retail.
Thanks, Dean. Good morning. My name is Zach Williams. I'm with Newmark, as Dean said. Thanks for your time. I'm going to have the daunting task here of talking a little bit about the retail environment. Want to leave you with as much of a positive outlook as possible, but got to state the obvious, and that's COVID. We've obviously seen a number of St. Louis institutions in general, Paul Minios, restaurants along those lines that have closed their doors for good, and that is directly due to the pandemic and COVID. The dining room era is very difficult for restaurants these days. So, I think the moving forward, adaptive reuse, reutilization, creative thinking, and an online presence are really the key to the to the retail environment. Fairly obvious, again, with COVID, counties and states put regulations and restrictions on capacity numbers, and a number of businesses have really gone south because of that. The ones that I see that are adapting well enough are changing their models to curbside pickup, whether it's a restaurant or a boutique. And I think really the biggest component of that is an online presence. You've seen, as I know many of you have probably ordered food, most of these are going to a new platform online just to order. You can't even call them anymore because they don't do that. So the online presence is really a big piece of all this. I've got a client that's a women's boutique store, and she obviously had to close her doors with the capacity and regulations and the quarantine. But she basically set up more of a website that was much more of an online presence and had the ability to really give sort of a personal shopping experience to her customers. And her customers have really responded to that. And she told me that she was actually up 5% over last year just because people are at home and looking online. And once she was up and running, she was able to sort of put things together, outfits together, jewelry together, and put them outside the door and people could pick them up. So I do think, as we continue to go forward, we're going to see more closures, not just of the mom and pops, the nationals too. Gold's Gym is a big example here in St. Louis of that, closed all of the locations, realizing they were having somewhat struggles before COVID, but that just expedited it. So, as we started 2020, I think the retail market was pretty strong. And by March 13th, when everything really kind of came to fruition, started going downhill. I know I personally have, lost a couple of deals. Restaurants really that are just a little bit nervous about expansion, even though they're fast casual restaurants and they've really adapted to everything. Being able to order online, do curbside pickup, and a number of them even hired delivery people. So they'll deliver within a 5-mile radius. As far as positives go, I think what I said earlier, looking at the retail market, reutilizing space, creative thinking as far as the procedures go, and really the online presence is a big piece. We've talked a few times here about Amazon. Amazon from the retail perspective, obviously they're a large company with deeper financial pockets than pretty much any company out there or any individual. So they have the ability to sort of change on a dime, but they just opened their first store in the St. Louis Galleria called Amazon 4-Star. They've also got three other concepts they're rolling out: Amazon Books, Amazon Go, and Amazon Pop-Up. Another Amazon 4-Star retail store will be opening in Kansas City in the next couple of months. I think they're targeting Country Club Plaza for that. So Amazon obviously is using their online presence. As far as the keys that I kept saying, I think we're going to see some shuttered big box spaces that are being readapted to industrial use, call center use, data center use. These buildings have large parking ratios. They have high ceilings, they have large column spacing, so they can, and usually dock doors as well. So they can accommodate these users like a call center that may need a huge parking requirement to get the 200 employees in there that they have working in there. I think some of the other, bright spots as far as opportunities moving forward, open air concepts. I know the district out in Chesterfield, I think that there will be an open air concept, and I think that those will really sort of take off in the future, as well as experience related retail. You go for an experience, i.e. the district is going to have venues, Topgolf is next door. So I think that there's some value and there's opportunity in that. The fairly obvious one is the neighborhood grocers and pharmacies. We all need to eat. Those are essential businesses. The grocery stores aren't going to close, but you really don't have to look too far when you go to the grocery store to see everybody in a mask, everybody wearing gloves. You go check out, you look like it's in a penalty box at a hockey rink. The plexiglass everywhere, lines that are 25, 35, 45 minutes just to check out. It's actually kind of unbelievable. Other retailers, I think, that are going to be successful moving forward are the ones that are adapting to the new normal. I had mentioned a couple of fast casual restaurants. I've got one that's a client that they've had their dining room closed since March, and they're up 15% over last year because they've really adapted to the curbside pickup model. They've also adapted that they're delivering, and they're actually delivering within a 10-mile radius of their store. So anyone that's going to be able to adapt to what's going on now with cleaning procedures, with delivering, with curbside pickup, they're going to thrive in the future. As far as some kind of local wins, I've got some leases I just kind of wanted to highlight over the past couple of months here, and then some developments that are coming on board moving forward. As far as the leasing goes, I had mentioned the Amazon store, so I think you can expect to see more of those pop up. Scott Credit Union actually signed on to be the first retail tenant in the PwC Pennant building downtown. That's their 4th location in Missouri. Out in Baldwin, Old Town Plaza has actually had 2 fairly large tenants. Painted Tree Marketplace, which is a home decor store, actually entered the St. Louis market for the first time and took 33,000 square feet. And one of the retail concepts that's going to have a tough time moving forward will be larger gyms and fitness concepts. You've seen Sun Adapt. There's one in Clayton by the name of True Fusion. They've taken all their classes outside. Remains to be seen what happens with that when it's 30 degrees, because doing yoga in 30 degrees is probably not too much fun. But I think that you'll see like Gold's close some of those. They're close their locations here in St. Louis, but you'll see some of those starting to pick back up and adapt to what's going on. Sort of going against that trend, and that same center out in Baldwin, Planet Fitness actually signed to 30,000 square feet about a month ago. And that was not a closed Gold's Gym or an old gym. That was a Marshall's. So they're really invested in the space. They're totally building it out to be a gym. And, on the medical side of things, I think that's another essential business. Urgent cares, pharmacies, and the likes. Total Access Urgent Care has just recently broken ground on a new urgent care facility at 8961 Page, which is up in Overland. And they've got some extra ground up there I know they're trying to sell. So, businesses like that, I think, where people have to go, whether it's going to be a COVID test or what have you, they probably feel more safe going into an urgent care than they do in a large hospital. 2 developments I want to really highlight that are coming on board here and starting construction over the coming months. The $150 million mixed-use project known as Olive Crossing, which is at Olive 170, is going to kick off construction in spring of 2021. If you drive down Olive, you probably see a bunch of work going on there. Most of that is MSD and stuff like that, so they haven't really started any grading. But they're going to deliver 45 to 60,000 square feet of retail, Q4 2021 or Q1 2022. They don't have anyone that they're really announcing as of yet, but they have announced that they have a 160-room Marriott that's going on site. And this will also encompass, right now, a 6-story office building, which could go up as they get tenants coming in. And a smaller development in the Fountain Park neighborhood, which is about a $13 million development located on Delmar Boulevard. They have announced some tenants. It's a mixed-use project, but they're kicking off construction next month. The UPS store will be in there, the original hot dog factory, Park Central Development, and a co-working space. So in closing, I mean, I think, hopefully I'm leaving with a positive outlook on what's going on. Obviously, retail is, one of the ones that's going to be affected the most by this. And I think you'll continue to see that as time progresses and counties and states, have restrictions, how many people can be in the business, who can be open, who cannot be open. But I think from a landlord perspective and from a tenant perspective, moving forward, if you can reutilize your space, backfill it with a medical use, be creative in how you're thinking and adapt to what's going on, people can be successful. Thanks.
Thank you, Zach. Positive spin. Mark Palmer is going to tell us about the office. Mark's with CBRE, the office guru in St. Louis, and he's going to tell us how it is.
Thanks, Dean. I appreciate getting me here towards the last. And Zach, I think you've got a great future in politics. Great spin. Terrific. I want to dispel a couple of things right now. We've been talking about COVID and the current pandemic. People have asked me about the first pandemic. I don't really remember it well, although I was probably around at the time. But having been in the business at CBRE since 1981, I've enjoyed several ups and downs and interruptions in your business, if you will. You can hear me in the back? Thank you. One of the things I'll say, about every 10 or 12 or 15 years, we have an unknown. We have a financial crisis. We have a Y2K. We have a pandemic now, which was somewhat, I guess, unpredictable before it happened, but predictable if you look back in time and the biological issues. And I think everybody knows, without my saying, that it affects the office market probably more profoundly, certainly more profoundly than the industrial market or the multifamily market. Somewhat similar to the retail market in some ways because of the service industry that the retail market supports. But one thing everybody has to remember in the room is not every office building is alike. If you have a single tenant office building and you have a lease that's expiring in the next 6 or 12 months, yes, you've got an issue. Be the same way in industrial, perhaps. But if you've got an typical office building with leases that have 5, 7, 10 years in duration, that are staggered within the building and its institutional quality, you're dealing with some tenants that may have 3 or 4 years left on their lease and they're still paying the rent. It's uncertain. Yes, uncertainty is the key word for office right now, because we really don't know how people, when they repopulate, how they want to repopulate, if they want to repopulate. There have been some, announcements, primarily .com type companies, although Accenture made an announcement here this last week that they are going to allow their people to work at home. Is that forever? I guess we will remain to be seen, right? But most people are working from home, or have been working from home, or working from their car, or working from the Starbucks, that are mostly office related, that aren't essential, that aren't medical, that don't need to go into their offices, and have found ways to make their business perform. I would think everybody in this room probably has interrupted in their business if they're primarily focused office. There's some interruptions because for the first time in many, many years, we're being asked, hey, can I kick the can? Can I do a 6-month lease? Can I do a 12-month lease? Could I do a 5-year lease with an out after 1 year? Or could I do a series of 1-year leases? So we're working, 5 times harder for a 1-year deal that would have been a 5-year deal this time last year. So putting that in perspective, most owners, particularly the owners that I think really get it, aren't opposed to working with their tenant as long as the tenant's been good and has been paying its rent and has a good story that they just don't know, or their corporation won't allow them to make this decision in this uncertain world. Well, the uncertainty is going to continue, regardless of a vaccine or antibodies, or who, accepts the fact that maybe there's a herd effect here that's coming sooner rather than later. Even if we did nothing, these things seem to find their way out. It's a dramatic time in the office market. Don't panic. My word is don't panic, because nobody can really tell you today with a great degree of certainty what they want to do 6 or 12 months from now. They're planning it. Even this idea of being 6 feet apart and putting the plexiglass up and having reduced occupancy, maybe 25 to 50% initially. I think the jury's still out on that. There's just a great deal of uncertainty. We hear all sorts of conflicting statements from people. At first it was, wash your hands. Now you're wearing a mask. Wash your hands and wear a mask. Stay 6 feet or 10 feet apart. Well, that's all great, but that's somewhat unrealistic in terms of when you want to have a workforce that you need to train. How do you onboard new employees if you can't train them? How many Zoom meetings have we been in where it's been interrupted by, the dog barking in the background, kids, events, the lawnmower goes off next door, or just the technology doesn't work. There are things out there as great as Zoom or some of these other Microsoft, others may be. I think people in general want to get back to the office, or at least want to have that option, have the optionality. And maybe it's not every day. Maybe it's not important that you're in the office every day, depending upon what your work is. Maybe you're out of the office most of the day. But primarily, I think there's a socialization standpoint, and to train and to be trained and to learn from others and just to be excited by what other people are doing and how they're doing it, will require that we have a certain amount of office space. It will change. The flexibility we talked about, workplace environment, and when we see more, CBRE has a rolling out of something they started well before COVID called HANA, and it really is set up to work with more institutional users in an open environment, having gathering spaces. I think there's going to be more of that flexible space. It'll be transitioned. It won't all be like it was before. It won't be a bunch of private offices. It'll probably be very flexible. We're seeing furniture makers really jumping through hoops now to figure out what's the right type of furniture and how could you reposition it, how could you reset it. And it's almost like this room we're in. You could have an open space with a bunch of flexible workstations in one day and then set it up the next day, and it's all in a training room environment. I think you're going to see more of that. Very flexible, very easy, probably very lightweight, and probably very demountable type furniture is very much in vogue. And the workstations of the past, where you saw them kind of regimented in a line, maybe going more to a pod effect or to some other kind of cluster effect. Again, keeping social distancing in mind. Now, I say that, I think that's what happens 6, 12 months from now. What evolves from after that, I really couldn't predict or tell you. I still think there's going to be needs for office buildings. Some of you, one of the questions was asked before this started, what do you think of downtown? I think of downtown the way I think of downtown St. Louis before COVID. If you had a great deal of vacancy and an older building that hadn't done much in the way of renovation or adding amenities, you're going to struggle to lease that space regardless of COVID. If you're in Clayton where there's 3.5% Class A trophy vacancy, you're going to still get opportunities to lease that space either now or soon after COVID, because it's still going to be sought after. So it depends on where you are in the market. All two markets are not alike. I can't just give you a patent. St. Louis is doing this, and there's a lot of statistics, and I'd love to have the kind of statistics that the industrial market has or the multifamily market has. But I can tell you right now, there are deals getting done. There are tenants who want to renew or need to renew. There are a few new deals that happened in the market kind of right at the beginning of COVID, thank goodness. And we're getting calls from some pretty significant tenants looking for blocks of 30, 40, 50,000 square feet, and have RFPs for tenants in the 10 to 20 range on a couple of Class A buildings in Clayton right now. So I don't think the market's dead, but it came to kind of a screeching halt, and everybody held their hand up saying time out. As we get maybe into the first quarter of next year, we've had a year of this, if you will. I think a lot of people will have to make some hard decisions, and those who were able to get the 6 or 12 month extension because their lease was near term up will have to then really make a tougher decision. Am I coming back to the office, and how do we get there? I'd like to tell you there's a lot of positives right now. There are some green shoots. There's new construction going on, which is interesting, although most of that was decided and started before COVID. Would they have done it if they knew where we were today? I think maybe not, or they would have delayed it certainly to find out where it is. And I think they would be better, it might have been better served. But the bottom line is it's an interesting time. You know, in the 39 years I've been doing this in St. Louis and been involved in the real estate business for 40 plus years, it's never the same. And everybody says this time it's different. It is. It's different because it's impacting each one of us individually in a little different way at home, or, you know, or your kids or your family elsewhere, or you're domiciled at home and everybody, you know, you're online with your kids at school, as Zach was talking about earlier to me. There's things you're taking on that you didn't have to take on before. The financial crisis was different. Will it come out better? I think it will. It's forced us to do the things that we were already doing to a small degree. Every one of us were probably thinking, gee, can I really, you know, how much should I be working at home, or can I work at home, or do I work better? You know, do I need to come into the office, depending on where you live or how far out you live from the office? Is it convenient? We can get it done. It's just a matter of how do you want to work and how do you feel best working. And I guess my final comment is I want Jeff Kaiser to know that Matt Bookstopper's taking me on as his junior partner in multifamily business, because if I don't do that, I'm going to have to split my time with the industrial guys down there. No, candidly, it's all going to be okay. You know, at some point in time, I don't politically, no opinion here, but I really think we need to settle down a little bit. It'll work itself out. The one last comment I would make, it's probably going to be a flight to quality. If you've got B and C type product, the C tenants will move to B buildings if they can get a better deal. The B buildings will move to, will suffer because the B tenants will move to A buildings if there's a little financial opportunity, and there probably will be some financial opportunities in certain buildings in the marketplace. So that's my final comment.
Thank you, Mark. Next, we have Matt Bauer. This kind of ties all market segments together in terms of incentives for development. Matt's with the Economic Development Corporation, the City of St. Louis. He's going to talk about opportunity zones. He's going to talk about other things in the time of COVID. And I asked him to do it present a PowerPoint because there's some technical stuff that I think is important that you absorb. We're going to go over, Ernie, on our time.
I'm on the first slide now.
Okay.
Okay.
Matt.
Yeah, and we're going to go over, but I think it transitions well into a couple of projects that are going to be presented in the next session. So hopefully it'll be worthwhile. So you can go ahead to the next slide. So I'll kind of run through these real quick, but I just wanted to hit some highlights on what the city and St. Louis Development Corporation is currently doing. Some before COVID with opportunity zones in our new economic development framework, but also some of the COVID response, and also just some baseline of some development activity at the end. So first of all, there's a lot of planning activity currently occurring in the region, and this is just a sample of a lot of the things that are going on. The one I've worked on specifically is the city's equitable economic development framework, which is going to kind of point us forward in our efforts, for the next decade, hopefully. But know that all of these efforts here are informing each other. So I think it's exciting that there's a lot of activity going on, and I think, as the announcement was made this morning about the kind of converging of a lot of the economic and social and nonprofit agencies into a single kind of mega agency, I think people are rethinking how things are going to work going forward, and all of these things are part of that. And hopefully we can move forward with more intention and efficiency to get things done in the region. Great. Go ahead to the next slide. So I'll kind of go through this quickly. I want everybody to be aware of the equitable economic development framework. And it's really what we're going to guide our efforts on going forward. So just quickly running through what our goals were when we set out to do this about 18 months ago. It's released publicly in a draft format that's available now. It will be the final version will be formally released in a couple weeks. But basically, to achieve annual growth in employment that meets and exceeds the national rate, reduce poverty rates across all racial groups, close unemployment and wage gap between minority populations and their white counterparts, increase the availability of middle wage opportunities in the city's job base, which part of the research found that, compared to other peer cities in the nation, we're really lacking in those middle wage employment opportunities. And also have more, get more employer commitments to help that middle and lower class workforce kind of move up the ladder. You can go ahead and move. Continuing reducing vacancy rates, both residential and business. Promote anti-displacement. We're seeing a lot of activity in concentrated areas and how to keep the long-term residents there while still moving the economics and the neighborhoods forward with new development. There's continued population decline in the city itself, so how to slow and reverse that decline. And then also, I think one of the questions at the end of the first one was, what are we doing in minority neighborhoods? And I think one of the issues there is trying to increase the capacity of neighborhood groups and development groups in those underserved communities. So we're taking in, trying to assist with supporting those efforts. And then all of this will eventually support the city's fiscal outlook. Obviously, COVID is made a downturn in the lack of earnings taxes and retail taxes and baseball game taxes, et cetera. It's going to be a challenge in the near term, but in the long term, trying to increase our revenue base by increasing employment and increasing the number of business. And then also creating greater transparency between the development agency, the city, and the public, so that it's easier to find out types of numbers that we're talking about and what's going on with development in the city, trying to modernize those outlooks and make sure things are available more easily online. And taking a more proactive, SLDC is committed to taking a more proactive approach to getting involved in moving development forward intentionally in those underserved areas. I think as looking back, we've been a little reactive instead of proactive. So I think that's one of the main changes that you'll see occur with SLDC moving forward. You can go ahead to the next slide. So this is just a high-level overview of the framework, and like I said, you can go online and see it yourself. But it's kind of divided into three sections: industry clusters with 32 separate strategies, places, which is concentrating on neighborhood employment clusters and kind of city large industrial clusters with 43 strategies, because those are kind of geographically targeted. And then opportunities to thrive as workforce initiatives, trying to support our lower middle wage earners and also small businesses. Go ahead to the next slide. I think another important thing that SLDC has been involved with in the last since March has been distributing CARE Act funds in various forms. So the city has initially approved 135 small business loans of $5,000 each, and then that was moved to a grant federally. It was moved to a grant program, and we've issued 800 $5,000 grants to businesses all across the city. 50% or more of those are in opportunity zones, promise zones, or are identified neighborhoods, strategic redevelopment areas. And then also, hosted webinars and met and counseled businesses, and also directed bulletins and more information via the website and emails about how to deal with the impact of COVID on the business community. Next section is opportunity zones. I'm the opportunity zone project manager. I have a compatriot at the agency, Daphne Moore, who's our chief opportunity zone officer. I won't go through given the time, I won't go through the opportunity zone. I think probably a lot of people here know, but basically there's reinvestment of capital gains in specified geographic areas. Gives you a deferral of those of the taxes owed on those capital gains, and a discount and an elimination of those taxes on any gains from projects, from investments in those areas over a 10-year period. So I think it's important to note that this is a federal tax benefit, not a local development incentive, and the agency, SLDC, or in the county or in any municipality doesn't have approval or oversight of these over these investments. So it eliminates the red tape there for these types of investments. The next slide just quickly shows where the opportunity zones are located in the city of St. Louis. And I think in the next segment, we'll have a couple, at least one, maybe two of the projects will be opportunity zone projects that will be discussed. And go ahead in the next slide. So what we found is that, as an agency itself, a lot of the bigger investors and bigger developers are able to handle the opportunity zone credit on their own. They don't really need our help. So really what SLDC's role is in the Opportunity Zone Initiative is just to kind of be a matchmaker, a primary contact for investors, developers, and stakeholders, answering questions from people. And also Daphne's really concentrating on working in those lower income opportunity zones to create partnerships and facilitate community outreach to create neighborhood and development capacity in those areas where right now it's significantly lacking. Go ahead to the next slide. So some of the activities we've done is we created an opportunity zone summary to kind of put it in is a very difficult and complicated tax benefit into kind of plain language that everybody can understand. That's available on our website. Created opportunity zone clusters from the census tracts and created a map. We've got data for every opportunity zone cluster and have profiles available for every opportunity zone cluster if you're interested in investing in those areas. That's available in Opportunity Zone Prospectus. And also we have a website specifically dedicated to opportunity zones where you can find a lot of this information. And importantly, it has a project portal. So if you do have an opportunity zone project and are looking to attract investors, you can fill out a project profile on the site. And it goes, we're part of a national network. So investors that are looking specifically for projects in St. Louis or projects nationwide to place their opportunity zone capital, that's available. I think the next slide just shows a lot of the partnerships we're working with. Rockefeller Foundation founded Daphne's is supporting Daphne's employment at SLDC. Work with EPA, Midwest Bank Center, Clifton Larson Allen has been really helpful in helping put together a lot of these opportunity zone deals, and various other like MasterCard stepped in a national nonprofit that's really focused on opportunity zones. Economic Innovation Group has stepped in and is going to be helping with our efforts as well. So I think one thing that's important is we are seeing, I think overall, although it's difficult to quantify deal flow because there's no reporting or oversight of opportunity zones, what we are seeing is a lot of interest. And I know, we've talked with a couple of developers that are traditionally, quote, central corridor developers that are dedicating a portion of their portfolios to patient capital type projects, and that. And so we're working on it, facilitating those. And the difficulties are getting those deals done in lower income areas just because the time frame and the difficulty of putting those projects together. Land assembly becomes difficult. But we're working on it, and and hopefully we'll see some soon. And I know one of those we'll be talking about shortly. And then finally, the last, you can skip ahead another one. So this is just all the projects or the major projects that have been completed in the last 6 months. The seven highlighted projects I'm sorry, these were completed over the last year or so, but the 7 projects highlighted were completed in the last 6 months, in total $900 million. And then the next one is projects that are currently under construction, although 100 North Kings Highway just recently opened. But so the 13 projects that started in the last 6 months total over $500 million in development cost. And just found out a couple days ago too that right now the total dollar amount of building permits approved so far in 2000 is ahead of the pace in 2019. So that's a very high level of what's going on in the city. Certainly, yep. And that really concludes my presentation. It was really quick, so I'm available to answer any questions about any of the initiatives or questions about development.
Thank you very much, Matt. Incentives have been a big tool in the St. Louis region, both city and county, and it takes a little longer. It's a little more complicated, but sometimes it's the difference between making a deal and not making a deal. So it's worth looking at. Do we have any time for questions?
Anything online, Todd? Question here, John?
Yep.
This is kind of for the industrial as we help them. COVID seemingly really accelerated a lot of trends. Can you talk a little bit about the last mile and how it might change?
You want to start?
Yeah.
Last mile.
Yeah, I think what we're seeing is the last mile sites are in high demand, and for food typically requires refrigerator or freezer space, which there's not a lot of inventory available. So it's probably going to require new construction to get those type of facilities closer to the consumers. And of course, we're challenged in St. Louis County finding sites that are properly zoned. So it's a challenge we're seeing. It's probably going to have to require some acquisitions of existing buildings and tearing them down to supply that. You're seeing in some of the big industrial box deals, them dedicating sections to refrigerated or freezer space. But we haven't seen a lot of it getting close to the consumers yet.
Any other questions? Thank you all.
Thank you very much. Great comment. Great second comment. Want to take a quick photo on the side? Okay, let's get into the next panel. Alfredo. Get a photo. I guess we're going to do here, Alfredo. Okay. Thank you. Appreciate it.
Okay, we have a great panel lineup coming up next. I'm really excited to hear about these projects coming online in the works. I know we have 2 folks. Everyone is here. Hello, Colleen. Terry, everyone is here, right, on the panel? Great.
So I'll say. There's nowhere for my water.
Okay, yeah, that's the card. I have your PowerPoint, so let's just give me a few. Thank you.
That mic is always hot, man.
Okay. Okay. Sam.
Click it on the top. Just turn it up, push that button up
Are we ready?
right there. Just wait.
Good I think we're into the afternoon or close to. Good afternoon, everyone. Thanks for being here, either live with us today or online virtual. It's great to see everyone. Somebody mentioned, I think on the first panel, that it was the first time they put a jacket on. And this is the first time I put high heels on. And I know many of you don't wear high heels, but it was pretty daunting for a bit there. We really do have an all-star lineup today. We've got a lot of great people up here on our panel, great developers, interesting projects. So I hope you listen to them and learn about their projects. We have some really true visionary leaders in our community here. So I welcome them to present to us, and we're going to get started with our first presentation. What we're going to do is we're going to go through and have each one do a short presentation on the project or projects that they would like to highlight today. And then we are going to go into a Q&A of the panel and then open it up for questions. So thank you very much. And I think I was remiss in introducing myself, wasn't I? My name is Terry Samples, and I am a partner at Miller Prost accounting firm. I am the director of our real estate and construction services, and I've been there for 25 years. I've worked with a lot of you people that I see out in the audience, and probably a lot of you out there virtually. So again, welcome, and let's begin with Sam. Sam is the developer director of the Steinberg Group, and he is going to present, I don't remember if you have one or multiple projects from the Chesterfield district. Nope.
Hello? All right. Thanks for having me back, Ernie and Midwest Real Estate Journals. It's a pleasure to be here. Today, I wanted to highlight a couple of our projects we have going on in Chesterfield. One that Zach mentioned earlier is the District, which is the former Tubman Outlet Mall, currently under construction. Keystone Construction has been great partners on that. So we're appreciative of that, and we'll be open next year, 2021. So you can hit the next slide, Ernie. That's okay. I can technical difficulties. I can jump into it. So basically, you know, the Steinberg Group's very familiar with the city of Chesterfield and development in the valley, especially with Chesterfield Commons. We have a couple acquisitions down there. We just sold a piece of ground to Jaguar Land Rover. So we're very familiar with the area, very comfortable there, and see it as a huge growth area for the city of St. or for the MSA of St. Louis in general. So the two. Kind of our first phase of the district is two anchor tenants, one being Main Event. Main Event's 40 plus or minus entertainment operator, focuses on bowling, billiards, you know, birthday parties, corporate events, high quality food, laser tag, really exciting concept. And, you know, clearly they've had some uncertainty throughout the pandemic, but they've really bounced back strong. And they're going to be ready to open next year. They're excited about opening, and they've been resilient through this, which is certainly positive news for us. The other anchor tenant is the Factory, which is a 3,000 capacity indoor music venue, state of the art. We're very excited about that. We've already got a bunch of shows lined up for next year, and actually some competition on certain dates once we get sort of to the fall. So we're excited about that as well. And these are really our two key, you know, pieces to kind of bring synergy of an entertainment focus to this area. You know, it's really a one-of-a-kind project in the country that has Topgolf. You know, iFly just closed on their ground, and now we're bringing some more entertainment users to the market in a specific location. That's really something that you don't see anywhere. So we're very excited about that. You know, our phase 2 will have an open area concept that Zach mentioned with new to market restaurants, local chefs, really those restaurants are missing from West County and Chesterfield in particular. So we're excited about that. And that will come online, you know, shortly after our anchors open and we build some synergy for the project. Clearly our other development in the pipeline in Chesterfield is Chesterfield Mall. Really what we're trying to achieve there is exactly what Matt mentioned earlier, which is, you know, kind of a city center in a suburban location. very high density, mixed use, both vertically and horizontally, live, work, play, somebody who can, go to their apartment, walk to the gym, walk to a cool restaurant, hang out in the pocket park or a dog park. And really that's something that's missing definitely from Chesterfield and really in a lot of suburban areas in St. Louis. So we're really excited about that. That's next on the pipeline, and that's all I have.
I think a lot of people are very excited to see that Chesterfield Mall regeneration and improvement. That's going to be great for West County. And yeah, I was actually going to ask you if I believe that's part of the suburban urban kind of congruence there, and that it will be a wonderful thing as that comes into fruition here. We're all looking forward to it. Is there more opportunity for development in Chesterfield? Do you think that's a growing area, or do you think it's kind of tapped out now with what we talked about residential and now your development, maybe a couple others in the works?
So from a retail perspective, especially traditional retail, clearly basically any tenant you want is there. So, from a retail perspective, I think we're pretty close to capacity, but, with the experience retailers and the entertainment retailers, I mean, it's such a regional draw anyway. You clearly have Topgolf and the Simon Outlet Mall to bring people from all over the MSA, but also from longer drive times. A huge sports presence down there. We finished developing the Maryville University Hockey Center down there, so they bring tournaments from all over the country. And then they have the soccer fields and the baseball fields that just have thousands and thousands of visitors every year. It's clearly a strong corporate presence there with Pfizer and RGA. There's a lot of potential there. What's missing is that suburban city center. And then, I think there's capacity for some more experiences and entertainment.
Yeah, we talked about that. The other panel talked about the experience level coming back. And as we go through our panelists, I think you'll see that theme coming through in some of what they're doing as well. We're going to move on to Phil Halsey of Green Street. And I think Liz Austin's in the audience with him. I know you have some projects that are online or coming online, and then some in the works. We hear a lot about Chroma, Terra, Armory, and some others. And again, you've done a lot of growth. I'm not sure if you've taken an opportunity for the opportunity zone in any of your developments or not. And so can you talk about your developments and maybe let us know that as well?
Well, good morning, everyone. My name is Phil Hultz, kind of the managing principal for Green Street. We have a lot of focuses, but right now I would say our primary one is Midtown, and it really runs from Kings Highway to Jefferson. For us, we have 11 project development sites that we own in Midtown. It's about $500 million worth of projects that have been completed or in our pipeline that we'll do and complete over the next 2 to 3 years. All of our projects are in opportunity zones, so it's a big driver in terms of raising capital from outside of St. Louis. It's also, our focus has really shifted to multifamily. Chroma, which you mentioned, is at the east end of the Grove, is kind of the high level experience that people are looking for in an urban environment, has a wealth of amenities, is walkable, is connected eventually by the Brick Line, which is really kind of that experiential trail that you're seeing in a lot of major cities, whether it's New York City, the High Line, or the Belt Line in Atlanta, 606 in Chicago. So there's going to be a whole new evolution of experience that ties people together in the city that Great Rivers Greenway is putting together. It's about a $250 million project. The first phase will run from Forest Park, basically, or the medical center, to the Grand Metrolink station, which is where our Armory is. And as that develops, it'll also split and go over to City Foundry to the north. And so all of this allows people to move in a more kind of connected way, more experiential way. It'll have art, it'll have lighting, security, and it'll be a new way for all of us to be reconnected and create a lot of economic development. So a lot of what we are focused on is how can we have a long-term impact in an urban environment. So it takes a vision of 10 years or more. And so what I've done or our company has done as a group is really accumulated about 50 acres in Midtown, which is no small feat. It involves a lot of assemblage, environmental cleanup, entitlement, and really going through that process with the neighborhoods as well to get their buy-in. And the reason we're down here is that this is the economic engine for St. Louis, our universities, our medical centers, the innovation district. Large corporations want that talent, so you're seeing a migration of a lot of people in and out of St. Louis coming here. And we're at the forefront because we're focused on providing that high level experience that doesn't exist in our environment downtown in a big way. And to do that, you've got to put a lot of cards on the table. And our goal is here to create each one of these uniquely and also have elements of what we've talked about earlier, is that experiential element. We did Urban Chestnut as an example, Rockwell. We're going to turn the Armory into what is called Armory Rec Hall. It'll be kind of sports, entertainment, special events. It'll have next door a live environment. We'll build almost 500 apartments. We'll have a podium with access back onto Grand and a whole host of amenities, but we're also at the Grand Metrolink station, so people can go back to Cortex, into the medical centers or downtown. So a lot of what we're doing is really creating neighborhoods with strength, depth, and investment. And a lot of this is driven by the fact that we can bring Opportunity Zone. We have investors from around the country. We have banks, because of the scale of the transactions. Chroma and Hugh, which is our first apartment project down in the Grove, is a $100 million transaction. And it involved banks from the West Coast, investors from Texas. So you get a sense that a lot of this is happening around the country. And when they come to St. Louis, they're really embracing what's happening here because of the anchors that we have here that are so strong and so instrumental in any city's development, which is universities, medical centers, and tech industry.
Yeah, you're building communities, you're building neighborhoods and entertainment centers within each other to build communities, it sounds like.
Yeah.
With both of you kind of spoke on that.
Well, you drive your own success is what you do.
Kevin Bryant, we're going to feature him and his project next. Kevin is the executive founder and developer and president of Kingsway Development. I know you're in neighborhood opportunity zones and doing a lot of different developments within those. And you're also a relatively new developer within the community. So let's, as you go through your project, also talk about some of your challenges that you've gone through as a new developer and how the city may have played a part in helping you through some of these challenges that you faced.
Yeah, yes, all of them. I've had all the challenges. So I'm Kevin Bryant, the president of Kingsway Development. You know, we created a very aggressive development plan for a forgotten part of St. Louis that was actually on one of the most valuable tracks in St. Louis 50 years ago. The area primarily is Fountain Park and Lewis Place. So to give you an idea of where we are, if you take Del Mar to Kings Highway, Page to Taylor. So we sit right on the shoulder of the Central West End, which has kind of been the Mason-Dixon line. So on one side of the street, you have homes that are starting at $340,000. You could throw a rock, hit a $500,000 house. Across the street, you could throw a rock and knock a house down. So I had no expectations. I couldn't lose. So my whole thing is, at best, I'll fall upward. So I'll give it a shot. We work with SLDC. I first started collecting the tax around there. There was a forgotten special business district tax. So when they asked me to serve as president, it was about $60,000 in the treasury. I matched it with my own money, and we hired the best urban planners and architects that we could find. We wanted the same level of planning that was happening around St. Louis. I was a big fan of what Phil was doing. I love the Chroma building. I can't stay out of Chesterfield. I learned to play at Top Golf, learned to play golf there. So it was no place to go but up. So we started planning what can be here. You know, the homes were built the same time as the Central West End, so they're the same rich brick architecture. So then it became a matter of, well, we're going to need subsidies. It's going to take about $200,000 to build these homes back up, but the houses were appraising for $60,000. So what we had to do was figure out what was the magic number for the elephant that's not in the room right now, which is banks. What is their magic number to get them to reinvest in this area? So we knew we had to start with about 6 homes in the residential side. So we did that. We bought every vacant flop house we could find. We boarded up all the ones we could. We started working on crime. We worked very closely with the community to get them involved and feel a part of it, because there was a lot of changes that's coming now. There was a lot of fear and apprehension of what was coming, because when you start to improve a neighborhood, your taxes go up. So people are now wondering, they're starting to resist development, which was weird. So they were like, we don't want our taxes to go up. Well, your taxes are not low because you're winning. Your taxes are low because the neighborhood sucks. So if you want those pickups, that trash to start coming back, if you want the police presence, you have to start investing in the reinvestment of this neighborhood. So with that said, we started with the first 6 homes. We now have $1.2 million worth of residential construction going on right now. That was led by what's called NPA tax credits, neighborhood preservation tax credits. Those are worth about $70,000 a piece. So now I could put $200,000 into a home, but I'm really only putting $130,000 in a home. So now that home can sell for $180,000, which is the affordable housing ceiling, and I'm not displacing anyone. The downside of the community was there was a lot of vacancy. Well, it became the upside. So now there's no displacement because we're doing infill. We're not displacing anyone. In fact, we're trying to teach the residents that are there how to age in place. Then the exciting part became, and you can go to the next slide, was Del Mar. Del Mar. We're right on the shoulder of the Central West End. It was a commercially zoned major street. And again, looking at Manchester as our role model, how do we create something that could work on both sides of the street? So the first thing we did was we purchased 2 historic buildings. One was 30,000 square feet and the other was 36,000 square feet. And we started trying to attract entrepreneurs for it. We started as a co-working space, but it became oversaturated real quick with that market. So we started to shrink and create smaller offices, and then COVID hit. So right before we started closing our financing, COVID hit, but even that became a blessing, because had we got construction done last year, we would have opened during a pandemic. So now we're able to wait and do construction during 2021 and open the fall, and hopefully by then, a lot of the barriers that we had during COVID would be lifted. Next slide. Now have a campus where those 2 historic buildings are, which are going to be right across the street from a 4-acre lot that we bought. That lot sits right across the street from a market rate apartment that Diane Cullinan built. She's one of the rock stars in development. I wish she was here. But she also set the precedent that we can do market rate apartments along that shoulder. So now we're planning a 150-unit apartment building directly across the street from the 2 historic buildings that we're turning into office space. So with that, we have about 14 other projects that are in the pipeline. I could talk for hours. A healthcare village, an abandoned school that we're turning into a senior center, and we have 100% community involvement. So it's a lot.
So what gave you that passion, or that, whatever that feeling was, that that made you get started in this?
Well, my office sat right on the corner of Del Mar and Euclid for about 15 years. I actually own a marketing company. That was the background. So it was one of those things where we watched the neighborhood behind us collapse, but the Central West End was booming. You know, a Whole Foods, brand new apartment buildings. And, you know, it was kind of like, let's see if we can try and do something about what's happening in the rear. And then the catalyst point was we had a client that was supposed to meet at my office for a 6 o'clock meeting, and he got robbed waiting on me to get to the office. So at that point now, as a business owner, I have to move. My computer works the same in Clayton as it does in the city. So I had to decide whether or not I was going to run or I was going to be about the community development that I always talked about. So we gave it a shot. We got support from Otis Williams and SLDC, and we got a lot of luck. We got very lucky. We were able to raise the money, and we were able to move forward.
That's great, because you didn't just dip your big toe. You jumped all in with this project.
Oh, I didn't know what I couldn't do.
Or what you could.
Right. So the simplicity of it was breaking that neighborhood down into the 14 projects. We didn't take on one big project. We broke it down into smaller projects and attracted the support.
Yeah, that's great. Great story. I love it. Now we're going to move on to our next panelists here, Dan Buck and Colleen O'Neill of Big Sports Properties, featuring Powerplex Sports and Recreation. Introduce yourself a little further and talk about the project, and tell us about some of the construction timelines that you're looking at.
You bet. Thanks, Terry. Thanks to RE Journals and all the work going into this. It's not easy pulling off one of these things in the COVID world, I'm sure. So you've done a great job. Well, no good deed goes unpunished. This project has taken us over 4 years. And anytime you embark on a public-private partnership, you obviously are going to forecast some challenges, but there's been one constant during the 4 years of this development, and that is the unbelievable growth of the industry itself. Youth sports tourism continues to boom. Even in a post-COVID world, it's clearly has shown its ability to be resilient. The numbers around youth sports on the very first slide are just, these don't lie. When you see companies like Disney and Dolly World and Cedar Point and Six Flags and Comcast and Dick's and big investors like BlackRock and Bain Capital coming to the table with hundreds of millions of dollars to build new facilities and field houses and ballparks and dance venues and complexes all over the country, you know that it is an industry with a great future. The industry is quickly changing too. In the last 6 to 8 years, we've seen it move from a municipality and city, county-driven type government project to more and more public-private partnerships and more business leaders stepping into this ever-growing industry. Right now, there's more than 20 major sports across the United States that offer regional and national tournaments. There's more than 30 million children who play within those 20 different groups. The industry itself continues to grow, more and more sports coming online. Pickleball, believe it or not, is becoming a huge travel industry where seniors are now getting into it, adults are getting into it, and they are going to regional and national tournaments and spending money. We're seeing this sports tourism traffic now starting to cross across all demographics. It used to be kind of the kids leading the way. Now we're seeing the millennials. Now we're seeing middle-aged people. We're seeing seniors. I play men's baseball. I go on 2 national tournaments a year to Florida and Arizona. The fact this industry continues to grow, and to put it into context, you see that number on that the second slide, if you advance it 1, there's a number that shows it's a $20 billion industry. To put that into context, the National Football League is a $14 billion industry. And I would argue that the $20 billion spent by youth sports consumers is a much more diverse spread across most of the audience. It's not in huge TV contracts. It's not in huge sponsorships that are held by the clubs. This is money that is directly spent within the communities of which these families play. We're talking hotels, restaurants, retailers, gas. Think of all the ways in which this consumer spends money, and it's not a one and done. The National Football League is a 16-week schedule. This baseball, softball, volleyball, basketball, lacrosse, it is a 52-week-a-year industry that is constantly driving traffic each and every day to the consumer products and services and consumers. So this next slide is the Powerplex uniquely being a national leader. It's the vast amount of amenities and resources we'll be able to offer. Everything you see on the right of your screen on that slide is the things we'll be creating with our $60 million redevelopment of the existing Mills Mall in Hazelwood. But everything you see on the left are things that already exist. And all we have to do is go find great partners and quality tenants and operators for the 15 cafes, the restaurants, the bars, the go-karts, the miniature golf. We already have a great partner on the theater redevelopment. We're going to hand deliver more than 5,000 athletes each and every weekend to the consumers in this building. That's just athletes. The national average, according to the Sports Commission, is 3.2 visitors per athlete. So if you do the math, that's somewhere between 12 and 15,000 people on this campus each and every weekend. That is a great driver. Then you say, well, Dan, what do you do Sunday through Thursday? We already have commitments of over 500 athletes nightly who will practice in this venue. Parents are dropping them off, and that's baseball, softball, volleyball, basketball players who are there Sunday through Thursday doing their practices. So the campus buzzes literally 7 days a week. The following slides, and it's kind of a show and tell, just kind of what the campus will offer. The first slide is really just highlighting the dome. It'll be the largest indoor play space in North America. It holds 3 NCAA softball fields under roof. It's 750 feet long, 300 feet wide. It goes 110 feet in the air. The manufacturer of that dome, by the way, is a St. Louis company called Horizon. So we'll be keeping that. Their manufacturing center is in Granite City, Illinois. So it's a great product. The next slide just shows Ameren Stadium, I believe, is the next one up. Ameren is not just putting their name on a building, they're also building a solar grid over the entire parking field. All of our lights, all of our scoreboards, all of our concession stands will all run off renewable energy. The next slide, I'm just trying to see what you've got up there. Basketball, volleyball, Bradley Beal is one of our partners and owners. He'll bring a great basketball presence to the venue. We'll have 26 hard courts, 22 of those are volleyball. The way in which we're designing this, though, is completely universal. So one weekend we could run a 46-mat wrestling tournament. The next weekend we can run 26 volleyball courts. The next weekend we can run a national pickleball championship. Each and every one of these venues is designed to be very versatile in who we can host and who we can have. And the next one I see is that the volleyball venue there? Pickle Beach is indoor 8 volleyball courts. We have 8 beach volleyball courts, 10 pickleball courts. We have bags. We have golf simulators in this. It's a 110,000 square foot sports bar. It's got 3 bars. Anheuser-Busch is putting in a beer garden that has a Stella bar and what was the other product? Stella and I'll think of it. Also, Ultra Bar, who's the national sponsor, will be overlooking the 4 main beach volleyball. They're the national sponsor of the Professional Volleyball League. So the Ultra brand goes right along with beach volleyball. Then we have a 3rd bar that serves the 2 outdoor courts as well as 2 indoor courts. And I'm going to turn it over now to the next slide. I'm going to let Colleen kind of give you a feel for all the retail opportunities that still exist within the space. Lots of opportunities for sure.
Yes. So just to give you, my name's Colleen O'Neill, and I'm Director of Real Estate for Powerplex. So it's such an exciting opportunity because I came from the retail side. And so now to be kind of working on a unique project that I feel like retail is taking its next steps is very exciting. So I'm happy to be here today. And just so you guys kind of have a little bit of an idea about these families that are traveling, a lot of them see the value in character development and confidence as a result of participating in sports. So these families are coming from a 12-state region. We're averaging 2 times the national average in income. So they have a lot of money. A lot of times they're using this as their vacation and they're bringing, grandma and grandpa and other children in tow. So the average spend of these visitors from out of town is around $249 per person a day. So it's not from a parent who has someone in volleyball, it's not a cheap thing to be a part of. But with that, we are expecting about 2.9 million visitors a year. And to break that demo out, you're going to have your out-of-town guests. And about 75% of our tournaments that come in are going to be from out of town. We capped that so that we were getting those increase in spending dollars, that $249 per person. 25% of the tournaments will be from in town. We also have kind of talked about 250,000, hotel rooms a year that are booked. So a high number of hotel rooms booked and a lot of disposable income that's going to be going into the area. And then the other end of the spectrum, we have the in-town guests and teams. And as Dan said, about 500 plus teams will practice throughout the week. 250 plus competitive groups. That's a lot of millennials playing, pickleball and then heading to the beach bar after that. And then you also have to, can't forget that there is a need in the area for other people who are just curious about what the development has, as we'll have some entertainment, as Dan mentioned, in terms of we have the ice rink that'll be there. We have a theater. We also have go-karts, laser tag, putt-putt. So those things that'll naturally attract customers as well. So the next slide we can go to. So we are about 1.5 million square feet of space in that former Mills Outlet Mall that's been sitting there forever. So in terms of an adaptive reuse, we are looking for all kinds of different retail uses, everything from service to restaurants to entertainment. And some of that, these families amidst the COVID, they are so committed, as you've heard, to getting things back to normal. And they know how important it is for their children to be involved in these sports. So, the other thing is we're looking for retailers that are able to, be able to entertain large groups. So when a group comes in with 40 people and they want to have dinner all together as a team, that they can accommodate that. And then also, the in-town folks, when they're waiting there for their kids who are doing practice, 2 times, 3 times a week for 2+ hours, what can they do? So then the next slide, I just have the site plan. So as you can see, the green areas are some of the committed areas that we have. And then
The
you
next
can
slide. Yeah, go ahead and advance to the
Sorry.
next slide with the map up. There
Thank
go.
you. So the green are committed areas that we have. The far north is the dome. And then you can see Cabela's at the end of the screen. You can see the ball fields that will be built. And then the surrounding red areas are opportunities for outlot development. Anything from hotel, convenience store, fast casual, fast food, all of those areas are going to be areas that are available for retail, restaurant, service development. So that, and I'm going to turn it, Dan has one last slide.
Yeah, and this is just something more from a philosophy standpoint. She touched on it briefly about the real importance that families put on this. This takes your business development from kind of the financial and intellectual value that we've been in for a long time and gets it to more of a relational value. Don't know how many of you have really looked at or studied what relational value is in a business model, but it's how companies create impact by investing in things that really matter to the consumer. I'll just tell you, as a coach for 22 years and as a parent of 3 athletes, there was nothing in my life that was more intrinsically important to the development of my kids outside of church and school than what went on those ball fields. And to see them as young adults today, to know what that value was and to see what great teammates they are, this is where you can connect your product, your services, your things to something that really matters to young families. And that little fraction of where it all overlaps between this relational value and the financial value and the intellectual value, we have a unique opportunity in St. Louis to position ourselves way ahead of all these other sports venues who it's a business model only to them. They're not really looking or listening to what the consumer needs. Or how many of you are touched by the youth sports community where you're one person removed either as an athlete, yourself, or as a parent or as a grandparent or as a kid? Raise your hand just real quick.
I'm going to guess everybody.
Well, I mean, most people are one away. And that's another point too, is that you're going to touch so many different lives in this industry. And the ability for St. Louis to position ourselves as the national leader and doing it better than anybody else. I'll just tell you guys, this campus doesn't exist anywhere in America. Not at Disney, not at Grand Park, not at Lake Point in Georgia, not at Sports Force up in Georgia. This kind of an all-inclusive campus where you're listening to the consumer and delivering to them what they want. My dream of a coach was to park on a Thursday and never get back in my car again until Sunday, because everything my family and my siblings and people needed were all on one campus, from restaurants to retail. And if I want to go to a Cardinal game or I want to go to the zoo, I'm getting on a shuttle with my team and my families, and we're shuttling to those places and not having to try to navigate a city we don't know. We have a really great opportunity with the Powerplex to vault ourselves from being out of the game, and we truly are not in the game right now. We're getting our butts kicked by Kansas City and Indianapolis and Nashville in this space, to put ourselves immediately in front of all of them with probably the most dynamic youth sports campus anybody's ever seen. Now, there's a big one going on to Mesa, Arizona right now, but that's not going to be a competitor. But in this Midwest region that's competing and fighting for this tourism dollar, St. Louis literally overnight, and we could be open as early as June. We plan to close at the end of November. We finally got our funding pieces put together. We plan to close end of November and have this thing open and operating by June of next year. So
Thank you. I can hear the passion in every one of your voices in your projects, and I think that's great. And I am also a parent of an ex-club volleyball player, and so that facility sounds amazing. I am past the point of needing to use it, but it sounds awesome for those that are. And I think, like you said, a lot of people in this audience are at that place. I know there have been challenges within the development for probably all of you, particularly with COVID. And I know for Powerplex kind of managed that a little bit with you did some graduations at your place. My daughter was one of those that went through that graduation ceremony at Powerplex, and it actually was really fabulous. You pulled that off amazingly. We were skeptical, and it worked. And so that was great. So I would like to hear some of your challenges through COVID and how you think you're going to be able, do you have contingency plans in place? What are you looking to do to kind of overcome some of this, for lack of a better word? We don't know when we're going to be out of it. Yes, youth sports is growing. Everybody wants to see entertainment. People are going to want to go out for that experience. But until the time we can get there, what time frame are you working with, and what are you doing to kind of manage those challenges? And in each of us, we're going to start with Sam, and you can all address it appropriately.
So there's two answers to this question. First, from just a traditional retail portfolio, I think if you have, so the government created a new term for us during this, and it's essential retailers.
Yes, essential businesses.
So essential businesses, even from a shopping center perspective, if you have a grocery anchored center with a Dollar General, a Dollar Tree, some restaurants that do carry out, you've been pretty successful. I think over our portfolio, we've collected about 90% of our rents, throughout the pandemic, which is, we're extremely happy with. But it goes into, structuring the deals correctly, picking the right tenants, and clearly, the gyms and the movie theaters, there's some people that, just got blindsided and there was really nothing they could do. But, if you set up your centers correctly, from a traditional retail perspective in that essential retailer space, I think you can still be successful. You just have to look at that going forward. I think the biggest thing keeping developers up at night, and this is over all sectors, is, consumer behavior is going to change, has changed. It's which consumer behaviors are going to stick, whether that be work from home, whether that be carry out, outdoor dining, although what are we going to do in the winter? It's those, consumer behaviors that are going to stick. Predicting those is nearly impossible, but the people and the retailers and the developers that can best adapt, to the changing trends and can be flexible are the ones who are going to have success going forward.
Yeah, I'd like to see those interesting things people may do for that outdoor dining aspect in the Midwest. The people, in California, Florida, different locations might be able to manage that a little bit better than we can here. That I'm interested to see how that plays out as well. Kevin?
For us, it may sound weird, but it's been barely an inconvenience, almost a help. I've watched interest rates drop on Fed money, so I was happy.
I always say debt is cheaper than equity. So.
Exactly. Had we opened this year, would have been a disaster. We had a lot of public spaces planned. The biggest thing that it hurt from a planning perspective was we were talking with a couple restaurants that would have been really impactful along Delmar, like First Watch. They're no longer, accepting new franchises. So outside of that, 2020 has been still planning, making little adjustments here and there. We saw COVID almost as an accelerator of some problems that was already in the economy. But the community I was redeveloping was already in a pandemic before we got started.
Good
so
point.
it was how do we navigate this problem and plan for the future? So I think we'll be all right. 2021, 2022, it'll start to level off.
So this was maybe a blessing in disguise for you in some ways.
Had we opened our office buildings in June of this year, had we planned, it would have been a disaster. So it's actually been a blessing.
Good point.
Well, I totally echo that. Thank God we didn't close last August as planned, because we would have been opening in March. Can you imagine?
And then shutting down again.
Yeah, our industry in St. Louis County has been shut down 7 months. We have 10 volleyball courts. We have a baseball, softball training center. We had invested a lot of money into already. So we've been dead in the water. That's why we had to do drive-in St. Louis. That's why we've had to do concerts and movies and graduations and do what we could to try to keep the bills paid while we were waiting for the banks. We lost a bank through the process who got a little squeamish on us. We had a gap to fill then on that. But what I think clearly our industry and the youth sports tourism industry is going to be a leader, not a lagger. There is no question. We did a national survey, over 8,000 responding parents of youth sports athletes in our 9 core sports that we'll be offering. And the overwhelming majority, the numbers were unbelievable, said they will return to youth sports before doing almost any other family activities, when asking them to rank, will you return to movie theaters? Will you return to theme parks? Will you return to national vacations? Will you go to international vacations? Will you go to pro baseball games? Will you go to concerts? Will you return to your youth sports? It was unbelievably overwhelming. Almost 97% of respondents said they will be returning to youth sports as soon as the courts and fields open. And they have proven that. Since that survey was done in early May, most fields, 111 other counties in the state of Missouri have been wide open, and they have been packing tournaments each and every weekend in soccer and baseball and softball, volleyball tournaments throughout the month of June where they were able to play. National sanctioning bodies have been very slow in endorsing and supporting the reopening, mainly because of the big states in California, New York, still being very closed up, Illinois still being closed up. So the sanctioning bodies are not going to overrule their states' leadership, but in states that are more laxed, they have opened it up, and there has been zero impact on the COVID numbers. Youth sports and athletes have shown that they are not transmitting the virus. There has been low accounts. I think opening Major League Baseball, opening the other major leagues also helped. Seeing hockey and NBA and football back on the fields, seeing college football teams playing and doing so safely, having college campuses reopen. We don't expect COVID-19 to have a long-term impact on our industry, mainly because the virus clearly does not impact the young at any alarming rate whatsoever. We haven't had a hospitalization under the age of 19 in St. Louis County in 3.5 months. So we know that the kids are pretty resilient to COVID-19, and their young parents are also not nearly the target or high-risk population. So we're hopeful and optimistic that the youth sports industry will be a leader in the return of tourism and not be a lagger. I wouldn't want to be probably in the theme park industry right now, because I think they're gonna struggle and have a little slower opening.
Yes, I agree. And that resonates, I think, with everyone, and to all of you that have some form of youth sports, entertainment, things like that. People are talking about our mental health and what we need to get back to, not only with youth, but with everybody, but particularly with youth. It's good for all of our exercise, getting out there, our mental well-being. So I agree with that. And Phil, let's talk, let you touch on this and talk about it. Did you have any shutdowns, construction delays? How did you manage through that?
Part of what you got to do in any situation like this is really understand your options and understand how you can manage people and experiences. And, we have been pivoting probably for the last 4 or 5 years to where we are today, which is residential. It's easier to finance. There's a void in a lot of markets. And some of it is a little bit of luck. We also have focused a great deal on industrial. Those tend to be more mainstream, easier to navigate in. They're easier to raise money for. The cap rates, all of that. The biggest challenge, I would say, is financing right now, because you got a lot of pause going on with lending institutions. So we've really broadened our spectrum of where we're going for money. And we've been very fortunate because of where we located our projects, that they have their own engine to help drive us forward through this. There's 70,000 people within Cortex and the medical centers, all, people that have to live, work, and play in some shape or form. So we really focused on underserved markets and being very nimble in how we come in there and how broad scope we are in terms of doing things. So I think you can fix things yourself, but it takes time, energy, and effort. And you got to have, a lot of experience, resources, and cash flow to manage these kind of times. And I think, what we're doing right now is selling a lot of assets. It's amazing to me how active buyers are coming into St. Louis, and most of them are out of California, New York, Texas. Those are probably the 3 dominant areas, and cap rates are still good. So we're recycling our money into the residential mixed use kind of destination entertainment that's very experiential. And we see that long-term as the place to be, and it's where you can make things happen. But you really have to manage every project, whether it's COVID, lending issues, or market demand. And it helps to be in the right place.
you said a keyword pivot, and I hear that a lot, and I think that is important for businesses, developers, everyone to be able to pivot in a situation, and particularly right now, I think that that's pretty important. We're talking about some of these new projects, and everyone has kind of discussed how is this going to transform your area, your business. Let's talk about from the overall market in St. Louis, and where do you see new areas of potential and where you might want to go next in your projects? So it's sort of a two-part question to whoever wants to take it next. Transforming the market in St. Louis, and where do you see the next great spot to venture in your next development, if you're looking that far into the future? Sam, you want to start?
Clearly, I am partial to Chesterfield at this point. So talking about how a project can be transformational. So with Chesterfield Mall, with, a high density, urban feel in a suburban market, I know we've kind of touched on this a bunch, but the effect that has on not only the city of Chesterfield, but the region in general, just with, not too many similar projects around, it can spur developments like it. Clearly, Wild Horse Creek across the way, we're going to have really good connectivity in collaboration with those guys. And I think it'll be a nice transition and kind of create a city center and, an epic development in creating sort of a downtown Chesterfield, which will serve basically all of West County and St. Charles County even. And so that's how the projects can be transformational. Just to, you do one big center project that has a draw, and you can just have an effect on basically everything around it.
Transforming Chesterfield to a live, work, play environment.
Exactly.
Which is fabulous.
Exactly.
I think I'll throw a plug in there too for the Westport Airport area. I think we have a huge opportunity. Ground is cheap. You have great community support. You've got easy to work with communities like Hazelwood, like Bridgeton, that are hungry for business, and they're really willing to work with developers and doing some creative things. You got great anchor tenants in Boeing and Mallinckrodt and Edward Jones, and people who are deeply invested in that area, not going anywhere. And the airport's going to need our help. To be a vibrant city, guys, we've got to have a vibrant airport and an airport district, and those hotels are going to be struggling for a while. That's why we're excited, that the Powerplex can bring over 200,000 hotel room nights to all those, that's about 7,000 hotel rooms on that 8-mile stretch that are going to be really hurting here. And I do think youth sports in it of itself, if you look at that 141 corridor, guys, if we can all band together and get 32 soccer fields, get the new ice rink, get the Powerplex, I'd argue it's the best 7 miles of youth sports in North America, that very few cities could compete with us. And if indeed we can market it right and promote it right, I believe we could, really put ourselves on the map as the headquarters of national youth sports in the country, and continue to invest in that corridor of that airport, 141, Earth City, Maryland Heights, Hazelwood, Bridgeton. I think there's a lot of opportunity. And then you throw in the new zoo project with their safari going in up there in the northern part of North County as well in the next couple of years. I think we could really turn that area around.
You're really talking about community involvement within your project, and that is very important, as you're all mentioning. Phil?
So I would say the biggest area we're pushing into that's needed in almost every city is workforce housing. And we spent the last 3 or 4 years assembling a team that's really got a sophistication of how do you put these deals together, not using light tech, which has been kind of a disaster, but really how do you engage banks through their community reinvestment? How do you attract investors who have a desire to accomplish that? And we're doing a project here in town on ground that we bought from WashU, and we're using a local investor that will reduce his return significantly to accomplish a commitment of 10-year of workforce housing. So instead of having a traditional market rate deal, we're going out and finding lending institutions, investors that want that to happen in a community. And we're doing one in Wisconsin with BMO Harris, where they're providing cheaper equity and debt. And it allows us to get to 80% AMI. And we're also doing that with market rates, so you get a blend, so you're not siloing people. We're doing the same thing in the Grove, where we're building market rate and workforce so that people aren't feeling like they're not part of the community. and having that same experience in high quality units, but it really is engineering it through financial tools and equity, and also opportunity zones help in attracting that money. So we're going to take that program outside of St. Louis and do it in many cities. So that's probably our new focus right now.
So you're looking at some unique financing opportunities, investor funds, opportunity zone money,
Yes,
and bringing that together for your project.
correct.
Kevin?
Well, I would be remiss if I didn't mention my neighbors. We're very fortunate to have Jim McKelvey right next door with Launch Code. He's also invested in the Central Corridor along Delmar with the Makers District. That brought us Magic House. We have a new Jamba Juice that's coming, vegan restaurant, Sweet Art that's coming on our property, which is new for the area. Then you go a couple blocks further and you have Maxine Clark, who's doing the Delmar Divine, $150 million project. And these guys are already wealthy. They could be retired in Florida. They chose to invest in the Central Corridor. So as a result of that, we're able to add value to what we're doing. So I think in a short period of time, we'll all be able to work closer together, particularly because WashU is making it so. They are going after $1 million planning grant to help coordinate all the efforts along Delmar from my area all the way to the Loop.
That's great. It sounds like you're really invested in that area. And each of you, when I said where you see the future, where's your next venture, you sort of talked about just where you are. You're going to stay where you are for now, which is fabulous. You really believe in and are invested in where you're at. I'm also hearing you talk about this different financing that you're doing, tax credits. I'd also like to challenge you, if you haven't already, to just look at other options and tax incentives that might be available for you. This is just because my background is in tax. There's other things in the tax world that might help you in getting your project kind of cash flowing a little bit quicker. So you may have already thought of some of those things, but looking at some new tax law provisions that might help you, or cost segregation, or some other things that might help you with your project, if you haven't already done that, to consider that. Anybody like to? We're at 11:34. I know we got started a little late, so we can probably go a few more minutes if anybody would like to add anything to your uniqueness of your project, financing, things that might help our audience, or anything of that nature. Otherwise, you guys all have fabulous projects. I look to the ongoing success of them, look for them to be rolling out and coming on market soon. And I'm sure, I know I'll be at them, and I'm sure a lot of our listeners will be as well. They're very exciting and fabulous for our community.
Questions from the audience?
Questions from the audience and online, and our virtual audience as well.
Well, I'll just say that I'm really excited for everything that's happening in St. Louis. I'm super excited about the Powerplex. Phil knows I'm a fan of his. Chesterfield, the Foundry, Ballpark Village. There really is a lot happening in St. Louis right now. And I'm a parent. My son is 23 years old. 10 years ago, I told him to graduate from college and don't come back. Don't look at St. Louis. You know what I mean? I'm stuck here. But now there's a concerted effort to really create projects that keep our young people in St. Louis, and that's very important. I get tired of going to other cities, and I'm like, well, I wish I lived here. But now we're kind of creating this synergy where 10 years from now, we can be that city, that people are excited to come to and live here.
We don't have that automatic wonderful weather that San Diego does, or those mountains in Colorado. So let's build something that we can be proud of and want our children to stay here for. Any questions out in the audience or virtual? Oh, we have one.
So we were fortunate enough to be across the street from Steve Smith, and one of our first conversations was how are we going to connect ourselves? We're on two, the highway splits us apart. We need to interact and connect, and which led to a bigger conversation that we really need to connect the neighborhood in a broader sense. So we initiated conversations with St. Louis Development Corporation, Washington University, BJC, St. Louis University, the Arts District, which led to other people getting involved, like the Taylor Foundation, Arch to Park. And when you get people together and you start thinking of how do we reconnect ourselves, we were fortunate to have Susan Trotman, who has a history and a reputation and a skill set to execute. She did the Arch Grounds, which was a massive transformation that reconnected to the city. And we put together a RFP process that brought together some of the top architects in the world to look at St. Louis and say, how can we connect our neighborhoods? Because when you create these greenways, economic development is magnified many, many times over. And it's where people want to locate, where they want to live. And through that design occurred. We chose an architecture firm out of Boston that is designed it in conjunction with the Lamar Johnson locally, along with other engineering and technical people here. And they're raising about $250 million. It'll all be raised privately. They have an incredible team and a dedication that is really kind of behind the scenes. It's bringing the people of money in our city, Civic Progress and foundations to the table. And they realize that this is such an important ingredient to revitalizing a city and connecting it and creating that energy that keeps young people here. And we have the basics of great architecture, great history, great amenities, wonderful parks. We're a great sports town. We need to be drawn together rather than kind of live in our own little neighborhoods. And greenways do that. So it's going to come Forest Park to the Arch through that central corridor. It'll run along the Metrolink because they've got the right of way. It's already started at Cortex when they built the new Metrolink station. The next phase will run from the medical center through Cortex to Grand Center. It'll split at Vandemeter, go into City Foundry, and run north all the way up to Fairground Park through the Arts District up Spring Avenue. The next phase, well, actually in that same phase, it'll connect to MLS on Market and go by Harris Stowe. It'll have incredible artwork, lighting, dedicated bike lanes. So it's going to be an experience that's different than you getting out on your bike and saying, I hope I can get from here to there without getting run over. And part of this is that you change a lot of the infrastructure downtown because it was built for a much bigger population. So you're going to take some of these streets that are 6, 8 lanes wide and you're going to make it more people friendly. New York did that. When Bloomberg was mayor, they really changed how people connected and created pocket parks, greenways. And when you do that, you see what the High Line, it's only 1.25 miles. This is going to be a 20-mile loop through St. Louis, north, south, east, west. And it will dramatically change. It's going to take about 10 years. But once it starts, everybody's going to want to be on it. And it's going to change how people perceive our city. And it's what you go to any other major city. Atlanta's doing the Beltline, which is 20 miles. And it has brought everybody together, and it's creating an economic engine that's more powerful than anything you can do of connecting people and getting people engaged with each other rather than kind of being isolated, living in their own neighborhoods. And the idea is to create diversity, equity, inclusion, and economic opportunity. And that's hard not to buy into. That's why you're going to see such tremendous support from all the people at the table.
And that's why it's great to listen to all of you talk, because there is that segment in St. Louis of all these different pockets. And it's wonderful to listen to all of you come together with this diversity and inclusion and connectivity and that forward thinking and vision that you all have. So I appreciate that.
And Terry, there was one more connector that just got added, and that's the old Hodiamont tracks, and that'll connect from Grand Center to Skinker, and it's going to cut through that north side area. So.
It's good to know. Anything else? We're at 11:40. Only 10 minutes past for such a wonderful program. Thank our panelists here today and everyone else. Just about 2 of us, 3 of us.
Thank you very much.
Thank you, guys. You guys did a fabulous job.
Oh my God.